Good evening. Good evening, the erudite speaker for the day, CA Yagnesh Desai sir, and my esteemed colleague in the council, Mr. Arun, and the esteemed members who are attending this webinar. Today I am doubly happy to be part of this program as Vice Chairman of SIRC. I am Pannaraj. I am not visible because the Chairman and Secretary of SIRC, Chinamastan and Mr. Naresh Gelli are preoccupied or occupied with a contingency, and they are not able to join here. So I am made to join in the last moment. So I have joined through my mobile. So please bear with me, and I am very happy to be part of this program for two reasons. Any program should have what is called a workshop like understanding of the subjects, number one. Number two, it should be very comprehensive one. So today's program has another important feature. Normally when we talk of accounting standards, it's only in terms of companies or corporate entities that we talk about. But as far as non-corporate entities are concerned, we are not giving so much of stress. So for this reason, I would thank the Accounting Standards Board of ICAI and CA Pramod Jainji, the Honorable Central Council member, who has taken initiative in conducting this program jointly with SIRC. So we are also happy for this program. Non-corporate entities, I think at least 80% of the practicing chartered accountants are involved in application of accounting standards for non-corporate entities. So these are very, very vital, and time and again the quality or comprehension of the accounting standards and reporting wants a much more improvement from the members. This is very sorry to say, but we should gear up ourselves to improve the quality. And as you all know, there is every responsibility is put on the fraternity, that is the chartered accountants who do the attest functions whenever something goes wrong. So under these circumstances, it is very, very vital for us to revisit the accounting standards and their applicability to the non-corporate entities. It is very happy occasion for all of us for comprehensive learning because 25th to 30th, that is 5 days, consistently, continuously, we are studying the accounting standards application and reporting also. I would request Speaker Yagnesh Desai sir to highlight the reporting aspect also beyond the applicability of these accounting standards, because in reporting, whatever they have understood while putting it in report, I think there is some gap or some more improvement in the presentation that is warranted under these circumstances. With this introduction, I am very thankful on behalf of SIRC to the Accounting Standards Board of ICAI, and also to my chairman and team of SIRC for giving me the opportunity to inaugurate today's webinar that is going to be there up to 30th. And today's topics, as you all know, are AS9 revenue recognition, AS10 property, plant and equipment, and AS16 borrowing costs. So with this introduction, I very warmly welcome the speaker for the day, Yagnesh Desai sir. Very warm welcome to you on behalf of SIRC. And also I welcome my council colleague, Mr. Arun. A warm welcome to you, and all the delegates, a very warm welcome to you all, and I wish you all a very happy learning. Thank you all for this opportunity. Over to Mr. Arun to introduce the speaker before he takes over the proceedings for the presentation. Thank you very much.
Sure. Thank you, sir. Thank you for the opportunity. So I'm very much interested to introduce our today's speaker, Mr. Yagnesh Desai sir. He's having the academic qualification of Chartered Accountancy as well as certified CPA at USA. So he's a member in Institute of Chartered Accountants of India as well as the American Institute of Certified Public Accountants. Has been a practicing since 1983, has a wide knowledge of audit of corporate and taxation matters, and also is actively associated with the activities of Institute of CA. He is an IFRS trainer for certification course of Ind AS conducted by the Institute of Chartered Accountants of India, trainer for diploma in IFRS examination conducted by ACCA of UK, composed and delivered e-lecture for accounting standard for the Institute of Chartered Accountants of India, speaker on accounting and auditing standard at various seminars of the Institute of Chartered Accountants of India, also delivered motivational speeches at various national convention and students conference, have trained many CPAs of Philippines on IFRS. Between April 2009 till date, delivered 1084 sessions and seminars in about 40 cities in India and abroad. This is his 1085th session at SIRC. Recently awarded ICAI 2020-21 Mumbai City by Times Group. He's having a hobby of comparing music shows, taken part in half marathon, completed sustainability report course and passed the exam as well. With this small introduction, I present before you Mr. Yagnesh Desai. So welcome, sir. The stage is yours.
Namaskar, Arunji. Thank you so much for introduction. And I missed out the name of the gentleman who had introduced, who started the board game for today's session. Can you please repeat his name? I want to thank him also. Who is the gentleman?
Pannaraj, our Vice Chairman of SIRC.
Pannarajan, Vice Chairman. Namaskar, Pannarajan ji, if you're there. And thank you for inviting. And I feel very honored and very happy that today, on my birthday, I had a chance to share whatever I have known with my professional colleagues and my professional brothers. So this is a very good memorable day, very my onerous and the task which I love to deliver on my birthday, and you have given me this opportunity to me. Thank you so much. In fact, my program Thank you, sir. My program was scheduled tomorrow, but then I requested to advance it today so that I can take the first session tomorrow at WRC. And thank you very much for accommodating me. Thank you once again, sir. God bless you. Friends, and good evening to all the attendees, sir. Those who have participated this program, I welcome them. How many participants by now? By any chance, can you tell me? Can anyone tell me?
135 plus, sir. We'll be expecting around one. We have close to 200 registrations, so we'll be expecting
all in one. I welcome all in one, sir. And we'll start with the first session, and there's a property plan equipment. Then we'll take the revenue, and then last we'll take the borrowing cost. Friends, this standard, I must say, is revised back in 2016, and this is on the same line as the IFRS. AS 16 and AS 10 are virtually the verbatim same standards. So earlier the standards concerning the property fixed assets and depreciation were dealt with by AS 6 and AS 10. But now AS 10 has been deleted since 2016, and AS 10 covers both depreciation and all the aspect of property plant equipment. Mind you well, the title has been changed from fixed assets to property plant equipment. Allow me a minute, please. Why it is not going back there? Okay, fine. And I must say something, that Institute of CA has come out with so much of the reading materials. It's volcano of reading materials, but since it comes free of charge, we don't value it. We don't read it. I'm a CPA from United States of America, and I realized that if I value the guidance notes and educational materials and other technical guidance issued by ICAI, it would be some $100,000 of value. If I had to buy this from CPA Institute of American Institute CPA, I have to shell out nothing less than 100,000 USD. That is the value, minimum value of in material issued by the ICAI. And friends, I have relied on many materials issued by the ICAI. So one first advice to you is that you must read the this material. And just a bit, please. Can anyone guide me, gentlemen? I can see your photograph and my photograph, which is hampering my PP here. So I don't know, how do I reduce it to that?
Here it is clear, sir, actually from our end. Monica here, it is clear from our end, sir.
No,
It's
that's fine.
80% of the picture.
I don't have that much access to my screen. That's what I'm telling you.
Yes,
So you want to enlarge your screen, sir?
Yeah, it's fine. Now can you see me? Now it's very clear. Am I visible and audible clearly? Okay,
Yes,
fine.
sir. Audible, sir.
So AS10 is verbatim same as in AS16. And the paradigm change brought in is in terms of the method of depreciation, and the one big change brought in by this AS10 is, as I mentioned here, there's a paradigm change vis-a-vis the method of depreciation. Under AS10 revise accounting policy, depreciation is not considered as an accounting policy anymore, but it is considered as an estimate. There's more to meet. There is more to it than meet your eyes, in the sense that earlier the method of depreciation was considered as an accounting policy, as a result of which, whenever there's a change in the accounting policy, it was accounted for retrospectively. Meaning, if I had changed my accounting policy from WDV to SLM or vice versa, then I had to account it for retrospectively. That was in the regime of AS6 and AS10. But now AS10 revised says that depreciation method, useful life, and residual value, all of three are considered as an estimate, not an accounting policy. Resultant, if I change my method of depreciation from WDV to SLM or vice versa, I don't need to apply it retrospectively, but I can very well legitimately apply it prospectively. A big change. Then mandatory balance sheet review, balance sheet date review of useful life, residual value, and the method of depreciation has been a new covenant in the AS10. Friends, as a gentleman has mentioned that, Mr. Desai, please focus on the reporting. Now here I want to draw your attention that the standard makes it very mandatory for the management to have the balance sheet date review of A, useful life, B, residual value, and 3, method of depreciation. This must be reviewed by the management at every balance sheet date, and any changes therein are considered as a change in a useful life, as an estimate, as a result of which you are supposed to apply this prospectively. Let's for example say that an equipment was bought, and on the date of acquisition, the useful life was 10 years. And let's presume there was no residual value. So this equipment was depreciated on an SLM basis at over a period of 10 years time. Say 10 lakhs is the cost of an equipment, 10 year is a useful life. So an SLM method is used. So you depreciate every year 100,000. After 5 years, the carrying value is say 500,000. Okay, 10 lakhs was the initial amount. After 5 years, it is 5 lakhs. And then after 5 years, you revise the useful life to another 5 years. Yes. So initially it was 10 years, 5 years elapsed, and now another 10 years. So what do? The carrying value at the beginning of year 6 is 5 lakhs. And the useful life is 10 years. So this 5 lakhs will be depreciated over a period of next 10 years. So the annual depreciation amount would be 50,000 as against 1 lakh earlier. You will not do retrospective accounting. No, because it is considered as an estimate. So that's one thing. and again a residual value which is considered to be maximum 5%. But the major changes are because of the useful life and method of depreciation. These three are the big changes. Another major change which is brought in by AS 10 is the bearer plans. So I believe in southern region, there's a lot of rubber plantation. Am I right, sir? Hello, rubber plantation, guys? Yes or no?
Yes, sir. Yes, sir. In Kerala. Yes, sir.
Yes. So that is known as the bearer plant. That is known as the bearer plant, and the agriculture standard, if any, will not be applicable to it. Agriculture standard, which is yet to come, will not be applicable to it. However, when the company is covered in the Ind AS, even for the bearer plants, Ind AS 41 agriculture will not be applicable. They are considered as property, plant, and equipment. Yes, sir. Even the bearer plants, even if they are the agriculture, even if they are the agriculture asset, it is still considered as a bearer plant under the property, plant, equipment. That we'll see, sir. Okay, and now why is this? Okay, so what is scoped in and what is scoped out? The bearer plans are scoped in, and we'll discuss later on what the bearer plans are. This standard applies to property and equipment used to develop, maintain biological assets and wasting assets, investment property as AS 13, and also the some assets recognized as per the other standards like AS 19. Property and equipment are also covered by the AS 10. What is not covered is the biological assets other than the bearer plants. Okay, like cow and all this, they are not considered to be the bearer plants. They are the biological assets. Vesting assets, including mineral rights and all this expenditure on the exploration for and the extraction of these are not covered. But equipment and machinery to extract the mineral rights, minerals or the oils and all these are considered as a property, plant, equipment. Now here is bearer plant is a plant that is used in the production or the supply of agricultural produce, like a mango tree, like a rubber tree, like tea bushes. All they are known as the bearer plants, and they are covered by AS 10 and not by any other agricultural standards. As far as AS accounting standards applicable to the non-Ind AS companies are concerned, they are they're yet to be announced as that. But as far as Ind AS is concerned, Ind AS 41 deals with the agriculture, and that standard is not applicable to bearer plants, and has a remote likelihood of being sold as agriculture produce except for incidental scrap. So now how do you do the accounting for this? I am showing the, see, in Tamil Nadu, I'm also aware that there is a lot of mango crops also. Am I right, sir?
Yes, sir. Yes, sir. You are right.
Yes.
Yes, yes,
So
sir.
a mango tree is known as a bearer plant. And now the question arises how to measure the cost of this mango plant, mango tree. So till such time you have the first crop from the mango tree, and that too a sizable crop, because I also hail from a place called Balsar, and that is also known as a Balsar, Alfonso of Balsar, Ratnagiri, Devgarh are there. And in our land, in our region also, we have a lot of mango trees like Alfonso and Kesar, right? So if I had to do accounting for the mango trees, which are known as a bearer plant from the perspective of AS 10, then we grow it, we nurture it, and whatever cost is incurred till such time you have the first sizable mango product produced, you keep on capitalizing those costs, the cost directly attributable to those plants. Now, the plants cultivated to be harvested is agriculture, like trees grown for the use of lumber. Now, a mango tree is a bearer plant, but a teak wood is not a bearer plant. Teak wood, a mahogany tree, is not considered as a bearer plant because it is meant for the cutting and selling it, right? Plants cultivated is produced, agriculture produce, when there is more than a remote likelihood that entity will be also harvest and sell the plant as. Now, sometimes they nurture the plants for being sold to someone else, because when you go to the nursery and all these, they sell the mango plants, the trees, and which is grown up to this height, So these are not considered to be the bearer plan. Now, highlight of revised AS10, very important to again repeat, introduction of the component accounting. This concept of component accounting was introduced by Companies Act 2013. In Schedule 2 to the Companies Act, they had said that an equipment which is otherwise look as a one equipment, otherwise function as a one single unit, may have some material parts, very important material parts, which have a different useful life and which can be removed and put it back into the fit it into the machine, and machine will still operate. So the standards sometimes call them a mother plant and the other parts. Mother plant is the main plant, which have a useful life of about say 30 years. And there are plant of the portion number A and B, which have a useful life of 10 years. So what the standard says, hypothetically, you break the equipment into two parts: motherland, with mother plot plant, which is 30 years, and portion plant A, which is 10 years useful time, life, and part B, which is 15 years useful life. So you depreciate plant or the portion A over 10 years time, portion B over 15 years time, and the main plant at 30 years time. But practically, let me tell you, very rarely people are doing so. So if I can ask one of the management personnel or one of the people from a person from the committee, so how many of you have seen the component accounting practically for the small and medium enterprises? I would say none. Has anyone seen, please? Hello? Has anyone seen this? And component accounting?
No, sir.
No. So it is very rare to see for the small companies or the other than the big corporates. Anyone in big corporates, we've seen very less. Incidental operations, we'll see that what these incidental operations are. But basically it deals with whether to capitalize the cost incurred on the incidental operations and which cost not to be capitalized. Bearer plants in livestock covered in AS10. Actually, bearer plants are covered and livestock are not covered by the AS10. Depreciation method, which you mentioned here, change in depreciation method, change in estimate, revaluation model has been brought in more explicitly. Again, I would say small companies or the non-corporate mostly do not go in for the revaluation model. Provision of the asset retirement. Now, again, this is decommission cost. Though, friends, it may not be applicable, but I think when it's my duty to dwell upon a standard, I must touch upon certain aspects covered in the AS10. I may not dwell much on that, but I think at minimum I must cover. Treatment of the compensation from third parties. Until the standard of agriculture covering is formulated. Now, here they say that livestock to some extent are covered, but till such time agriculture standard is being formulated. Now, this is something very important. We all know that purchase price, import duty, non-refundable tax, net of discounts and rebate, that will the first element of the cost. Suppose I have paid the GST, hypothetically is say about at 18%. And if the entire GST can be used as an input cost, then this GST will not form part of the cost of an equipment, because this is adjustable. This is an input credit, and I don't capitalize as a part of an equipment. However, if out of 18%, hypothetically only 8% is allowed and 10% is disallowed, so I will add 10% of GST in my cost of equipment. This is just to give an example, hypothetical example, that by any chance, if only partial GST is allowed as an input credit, in that case, you will not add 100%, 18% as cost of equipment, but only that portion which is not allowed to be offset against your GST output GST liability. And if any discount is given, it is net of discount. Now, there is a directly attributable cost, which is like an employee cost. But I put a question: which cost? Employee cost, which is directly attributable, which is required to bring the asset in the condition as intended by the management. to be capable of it, to be capable of being operated. Suppose if a company is constructing an office building internally, so whatever labor they've used, whatever architects or the other fees they incur on this will be capitalized. That employee cost will be capitalized because they are directly attributable. They are not considered as a general overhead. Cost of site preparation, you need to prepare for an equipment. Again, they need to prepare for the initial delivery, handling, input cost, installation and assembly costs, cost of testing, there's a test run, and professional fees like architects, valuer, engineers, and all this, and the borrowing cost. We'll see that. Borrowing cost is applicable only if the asset is a qualified asset, and we will see what the qualified asset is. But it's an asset which takes generally a longer time for the completion. Not necessarily a year, but longer time. But here I need to tell you something. Employee cost, as I told you, I put a question mark which. The cost which is required to set up, to produce, or to construct a particular equipment are fully capitalized. But the cost of training an employee is not to be capitalized. If Indian Airlines is paying money, so Air India is paying money to the Boeing company for training these pilots for the 777 Dreamliner, then the money paid by the company, Air India, to Boeing for training of an employee to operate the aircraft is not to be capitalized. There's a conceptual difference. The reason being, this cost incurred on the training of the pilots is not required to construct the aircraft, to build the aircraft, but to operate the aircraft, and hence it is incurred for the operations which is not necessary for constructing the aircraft. So this is where one has to be very careful. Employee training costs to operate, to run an equipment is not to be capitalized. Now, cost of testing. Here there is a recent development, not in AS 10 but in AS 16. So I presume that few of my professional colleagues, my brothers in SIRC, may be doing some work of the Ind AS. For their knowledge, I'll take just 2 minutes. But before that, I'll give an example. Cost of testing means when you conduct the test run, you incur expense on raw materials, labors, and other directly attributable overheads. Say you incur 10 lakhs expense, and you produce sample products, and you sell also the sample product, and you fetch about 600,000, say 6 lakhs. So you spent about 10 lakhs, you recovered 6 lakhs. What is the difference? 4 lakhs. This 4 lakhs is to be added to the cost of the equipment. But now from 1st January 22, globally there is a change. They say that you spend 10 lakhs and you received 4 lakhs, 6 lakhs. So this 6 lakhs has to be treated as a revenue and not to be deducted from the cost of equipment. This is a change globally. However, as far as India is concerned, Ind AS 16 is not modified. Ind AS 16 is not changed. It is still the same. What do you mean by same? I spend 10 lakhs, I recover 6 lakhs, balance is 4 lakhs. So I will add to my cost of the production 4 lakhs rupees. Under the revised Ind AS 16, globally they would add 10 lakhs to the cost and they will show 6 lakhs as a revenue. But this is not changed by the Indian accounting standard. Okay, so IAS 16 is not changed, but globally it is changed. And the borrowing cost is covered by the as far as in non-Ind AS companies are concerned, AS 16, and as far as Ind AS is concerned, it is Ind AS 23. I must tell you that there are two standards which are verbatim same as per the Ind AS. One is the Ind AS 16 and AS 10. Second is Ind AS 23 and AS 16 borrowing cost. So not much of a problem, but I'll tell you where people actually make mistake. Now, the initial estimate of the cost of dismantling and removing the item, restoring the site on which it is being located, this is nothing but decommissioning cost. Friends, we run a lot of accounting of the windmill companies, windmills. Many people were installing windmills because it used to give them a lot of tax benefit. It was deductible at 100%, fully deductible in the year of installation. So many people have done that. So there few of the companies where Ind AS was applicable or even AS 10 was applicable. So we argued with them that look, when you do this windmill farm in about 10 acres, 15 acres and all this, and you taken a land on the lease and all this, you have to account for the decommissioning cost. That is a cost incurred. That is a cost which is likely to be incurred mandatorily by some statutory requirement or maybe as a part of the obligation on the entity by some other entity. Like for example, you've taken a plot on lease. So the lessor will put an onus on the lessee that you must give me on as is various condition. So ideally they should have provided for it. But my practical experience is that, friends, people are somehow very scary and skeptical about capitalization such cost. They, the argument they place, yeah, Mr. Desai, what you say is correct, but at the end of the useful life of this equipment, there will be a residual value and we'll sell some scrap. So whatever cost we need to incur will be recovered by the scrap value which you are going to recover from the scale of scrap. This is not a correct argument. This is not a correct accounting treatment. So what is the correct accounting treatment as under? Hear me out very carefully. I have to presume three things. A, the estimated amount to be incurred at the end of useful life, say 30 years. The estimated amount is about say 30 lakhs. Useful life is 10 years. And discounting rate, that's the amount at which I borrowed the funds, is about 10%. So what do I do? 30 lakhs is my expense, estimated expense to be incurred at the end of the useful life. Useful life is 10 years and discounting rate is 10%. So I find the present value of this 30 lakhs discounted over a period of 10 years and say hypothetically it works out to be say 3 lakhs. My accounting entry is debit property plant equipment dash decommissioning cost, credit provision for decommissioning cost. I repeat, 30 lakhs after 10 years, 10% discounting rate. Hypothetically, the present value is 3 lakhs. I pass an entry, debit property plant equipment dash DC decommissioning cost, credit provision for decommissioning cost. Next year, this 3 lakhs will go up by 10% because my discounting rate is 10%. So next year my entry is debit finance cost, credit provision for decommissioning cost. This is known as the unwinding of discount. This is known as the unwinding of discount. At the end of year 10, this 3 lakhs will become 30 lakhs. Someone will ask a question, sir, what about the borrowing cost? Will this interest finance cost be capitalized? Answer is no. Answer is no. But friends, practically, I've seen that this part is very rarely applicable. I mean, people very rarely apply. So basically, if you go to see the directly attributable cost, employee benefit cost, cost of site preparation, initial delivery, handling costs, cost of tasting, professional fees, and decommissioning costs during the stage of construction, development, and acquisition are to be capitalized. Now the question arises up to what stage they are to be capitalized. So they are capitalized during the construction, development, and the acquisition stage. They are not capitalized after the asset is. Which word I should use, sir? A, put to use, B, ready to use. Hello? Which in your opinion should be the correct phrase? A, put to use, B, ready to use. Can anyone
Ready to
answer?
use.
Who given this answer, sir?
I am Pannaraj, Vice Chairman, sir.
Panarajji, your absolutely correct answer. Fantastic. So big clap for you, big kudos for you. Computer जी पन्नाराज के लिए 10,000 का पहला पड़ाव चेक बना दीजिए. So Pannaraj ji, here is a check for 10,000. Okay. So okay. Now there are certain costs. So the answer is there is put to use and ready to use. If it is substantially ready to use, can be used by the entity, then at this point in time, depreciation, at this point in time, capitalization stops and depreciation starts. So capitalization and depreciation are mutually exclusive. Depreciation starts when the asset is ready for use and not put to use. So stop capitalization, starting depreciation. Okay. Now there are certain costs which are never to be capitalized, whether it is ready to use or put to use or not ready to use or not put to use. And these are opening a new facility, introducing a new product, advertising a product, conducting a business into a different location, administration and other general overheads. They are not to be capitalized. So two stages: A, capitalization; B, depreciation, are mutually exclusive. The moment you stop capitalization, depreciation starts. And then you'll see the initial cost and the subsequent cost, initial measurement and the subsequent measurements. So initial, there are two things. First is the initial cost, that is to acquire the construct, and second is the subsequent cost, which is the cost of major inspection, overhauling, and is also capitalized. Now I'll give an example here. Suppose you buy an equipment for say 1 crore, and that requires an overhauling at the end of 5 years. At the end of 5 years, the cost of equipment is 1 crore. The useful life is 20 years. So ideally, in the absence of any specific information about the overhauling, let me correct my phrase. In the absence of any specific information about the mandatory overhauling of an equipment, I would have depreciated the entire equipment of 1 crore over a period of 20 years time. So my annual depreciation would have been 5% on 1 crore. Straight line method, assuming no residual value. However, now it says that there has to be a major inspection or maybe a complete overhauling of an equipment after a period of 5 years time. My cost of equipment is 1 crore. The useful life is 20 years. I would have depreciated 1 crore rupees over a period of 20 years time at 5%. However, conditions apply. They give one more piece of information. They say that overhauling will need at every 5 years. And the cost of overhauling is 10 lakhs. I am talking about out of an equipment costing 1 crore, of which 10 lakhs will pertain to overhauling or the major inspection. So what I would do now, I would now split this into two parts. A, 90 lakhs, B, 10 lakhs. 90 lakhs, 90 lakhs I will depreciate over a period of 20 years time at 5%, whereas 10 lakhs I will depreciate over a period of 5 years time at 20%. Why? Because that is required to be done at the end of every every 5 years time. So this will again bring to the concept of component accounting, Now you will say that, sir, I paid 1 crore rupees, the invoice is of 1 crore rupees, GST they've levied on 1 crore rupees. How am I to know that what it cost for the overhauling? But in that case, the manufacturer will tell you that, sir, this equipment is costing 1 crore comprehensive, but it requires the overhauling at the end of every 5 years time, and the estimated cost of the overhauling is 10 lakhs. Correct, sir? So that is to be added. So what happens at the end of year 5? At the end of year 5, your overhauling cost will become 0. You are depreciating at 20% on SLN over a period of 5 years time. So it becomes 0 at the end of 5 years. 90 lakhs will again come down at the rate of 5%. So 9 5s are 45, 4.5 lakhs per annum into 5 years time. Whatever amount it will be there in the books of account. Then you spend 10 lakhs for the overhauling, or maybe 12 lakhs, or maybe 15 lakhs. So what is accounting entry? You will capitalize this 10 lakhs, 12 lakhs, or 15 lakhs as the case may be. Now again, this is going to be there only for next 5 years time. So what you'll do, you continue to depreciate 90 lakhs rupees at 5% per annum on an SLM basis. Whereas 10 lakhs, 15 lakhs, or 12 lakhs, 10 lakhs, 12 lakhs, or 15 lakhs, whatever you spent for overhauling or the major inspection, without which the entity will not be allowed to use that equipment, will be depreciated over a period of next 5 years time. This is what I mean to say subsequent cost. So that is to add to replace for the servicing of it. So this is again considered as the as a component, and component accounting here will be applicable. Now this servicing measure overhauling is should be of such a nature that if you don't do that, you will not be allowed to use that for another 5 years time. You will not be allowed to use it at all. Forget about 5 years time. Now initial cost normally is by way of exchange of a monetary asset. Exchange of a monetary asset. That means I can give check, I can give some kind of an equity share, or basically I exchange with some notes or something like that. But basically it's a monetary asset. So the accounting is very simple. If I pay 1 lakh, I debit 1 lakh, but exchange with a non-monetary asset. Fair value the item given up or received. So I say that I am a software developer, and I have entered into a contract. Just a minute, please. I have entered into a contract with a computer equipment supplier, and I tell them, look, I will develop the software for you and you give me the laptops. This is known as an exchange with non-monetary asset. Now the question arises how to value it. The supplier then would argue with me that, Mr. Desai, my price is fixed, MRP is fixed. So what about your value? I said, now I'm developing this bespoke, a specific first time software for your company, and I'm not too sure that how much should I charge you. So in that case, the value of the laptops, the price of the laptop MRP is considered as an initial cost. Now, when you buy a bundle of property plant equipment together with one consolidated buy, as you buy in a bulk, in a block of a set, then in that case, you pay about 1 crore rupees for 15 types of assets, which includes building, land, so which include not land, building, equipment, computers, and then furniture fixers and all kind of thing. So then you work out the fair value and proportionately you charge you allocate this cost. PP acquired under the finance lease, we work out the present value of the minimum lease payment as the initial cost. Suppose my installment is 1 lakh per annum and I am paying 10 lakhs for 10 years. I bring it down to the present value by applying the incremental borrowing rate, and that is, say for example, hypothetically 2.5 lakhs. So my entry is debit property plant equipment credit the lease obligations. If I have received as a government grant, if I may receive a property plant equipment as a government grant, the carrying value of the item of it may be reduced by the government grants in accordance with AS 12, or it may be deferred. So I got two options. I got 1 crore rupees of equipment. I got 10 lakhs rupees of grant. So then I may reduce carrying value, initial carrying value by 10 lakhs to 90 lakhs. That's one. Second is I treat government grant as a deferred. I continue to carry 1 crore on the asset side and on the liability side, deferred government grant. Now PPE in the form of a non-monetary asset. I may be given some kind of a land, some kind of a building, some kind of a solar equipment to be used in my factory premises. So in that case, my point is that either I consider as a zero value, as a nominal value, or I consider the fair value. So these are the these are the treatment of the property plant equipment which is not acquired by giving cash but other than the monetary assets. Now, sir, I want to hear from you that you find this deliberation is okay, moderate, too speed, too high. Is it okay? Is it too speed or slow? I need to know from you, sir.
So let the
Hello?
members
It's okay, sir.
let the members respond. Let the
It's
members
okay, sir.
respond. No, no, let the members respond through chat box.
Yeah, so I may not be having exact. Okay, I can see chat box. Let me try here. Friends, how do you find it? Okay, second option. Sir, I cannot access the, somehow I am unable to see the chat box here. Can you please tell me, is it okay is it okay,
Yes,
or you
sir.
want me to?
Yes,
Okay.
I'll give you the organizer right. So we can see messages from audience that it's just in fine pace only, sir.
Okay,
I'll give
fine.
you the organizer.
Because sir, they are the boss today. In any webinar, the bosses are not you and me, sir. Bosses are my audience, right, sir? And we must respect that. Thank you so much, sir. Thank you, organizers. Thank you so much. So spare parts and service equipment, are they supposed to be capitalized or expensed out? The thumb rule is that usually they are expensed out, but there are two conditions in which they are not expensed out but capitalized. Now let's see. First is the materiality and the major parts, and second is whether they are material or immaterial. It is exclusive. It is exclusive. The first block say that major parts and major spare parts and standby equipment which are expected to be used in more than one period. So they are major parts and you are not sure whether you are using it now, whether you may need it now, because the lead time there is very high. There may be some equipment, some part which you get after 6 months time. So what do they do? They treat as a standby equipment or as a major spare parts, and those are to be capitalized even if they are not used. I repeat, even if they are not used, they are to be capitalized. The reason being, the concept of accounting standard A10 says that an entity will start depreciating the property plant equipment the moment it is ready to use and not put to use. Friends, those who are really into the deep of accounting standard, I would say that this will cause a deferred tax asset and liability. What do you mean by this? Because under the Income Tax Act, an asset is to be depreciated when it is put to use. And under the accounting standard, the asset is depreciated when it is ready for use. And if there's a gap between these two dates, it will give rise to deferred tax asset or a liability depending on the case. And the spares which can be used exclusively in connection with the particular equipment the spare is so specialized that it can be used only in this. Mostly this happens in the highly sophisticated industries and the aircraft industries. One is a Boeing, second is a Douglas DC, and third is Airbus. Certain parts which can be used in the Boeing cannot be used in the Airbus or something like that. So those are known as the spares which can be used exclusively in relation to certain asset. So these are to be also capitalized. Now I mentioned to you about the bearer plans. Now bearer plans are considered as a self-constructed assets, and there the cost model is applicable. It is determined that using the same principle as for the acquired asset similar to one produced by the entity for sale in the normal course of business, that is not covered in this. By mistake I have written is in this 8, but that is to be treated as AS8 2. Sorry, this should be read as AS2. Any internal profit or the abnormal cost of material are to be excluded. So when one department is constructing for other department, it is you to see that department A should not make any profit. But honestly, sir, this is part of the standard I have to cover. Otherwise, for small and medium companies, this will not happen. They simply buy out, finish. Are accounted, bearer plans are accounted for as the same way as the self-constructed item of property and equipment. And the reference to construction should be construed as covering those agricultural activities which are necessary for the cultivation of the bearer plants. I'm sorry. Now, this is something very important, and this may perhaps, I'm so sorry, and this perhaps may be applicable even in the small companies. Now, I just changed the, see, it says that incidental operation and what is the accounting treatment. The word incidental operation means that certain operations are required for construction, development, or production of this particular item. For example, you are constructing a mall, then raw materials are required, other materials are required, but the activity of letting the plot, open plot on the rentals during the construction stage is not required to construct the building, to construct the mall. So if an entity spent about say 100 crores for construction of a mall, and it took say 3 years time for the company to complete this mall. During this 3 years time, a smart company manager has thought of giving this plot on rentals for the car park. They spend 100 crores on the building and they earn say about 5 crores on the by letting the open plot for the parking. Now the question arises, should this 5 crore be treated as other income, or it should be reduced from the cost of construction of the mall? My cost is 100 crores. I received 5 crore rupees from letting of the open plot. Accounting treatment should be what? A, should I reduce from my cost of construction of 100 crores, or should I treat as the other income? For that, you need to ask a question. Is this letting out of the plot, open plot for the car rentals required to construct the building? Required to construct the mall? No. It is not an incidental operation. So what my accounting treatment? They are not to be capitalized. In otherwise, they are not to be reduced from the cost of construction. In other words, they are not to be offsetted against the cost of construction. So what's my accounting treatment? On the one hand, I'll show the cost of construction of the mall at 100 crores. And on the other hand, I will recognize this 5 crores as the other income, as my other income. Now let us take the example of the scrap. Scrap is generated during construction. Scrap is generated during the construction. And it is required because material is required. So this is known as an incidental operation. So cash or the income generated from sale of the scrap should reduce my cost of construction. So 100 crores minus 5 crores, I will show as the cost. 95 crore rupees I will show as my cost of construction of the mall. Getting my point, sir? What is the key dividing line? Incidental operation. Is the operation required to construct the building or not? If it is required, not to be offsetted, adjusted. If it is incidental, if it is required, then to be adjusted against the cost of the property plant equipment. And subsequent recognition, as I mentioned to you, that basically the condition has to be, it has to be a material part, and it should have the different useful life from the mother plant. So my mother plant has useful life of 30 years. Plant number A has useful life of 5 years. I said 10 years, which is what I give the example, and the balance and the other part B is 15 years time. So when I replace the original part of part A at the end of year 2, year 10, it will be 0. So that will be added, okay? And as far as part 2 is concerned, that will be replaced at the end of 15 years. By chance, if during first 10 years or 15 years, you need to replace before the end of the useful life, part A had a useful life of 10 years and part B has a useful life of 15 years. But at the end of year 6, part A has become, dilapidated and not functional. So you must have depreciated at least 60% of the plant A. And now you need to replace it because it's not usable. It needs to be discarded. It's not functional, it's not usable. This 40% of the value still remains in the books of accounts. Part A useful life 10 years. It's become not functional, non-functional at the end of year 6. So 40% is still in the books of accounts. And I need to replace that part A. What should I do? I should then de-recognize 40% of part A. Entry, debit, profit and loss account, credit, property, plant, equipment, 40%. Second entry, you spend again, say 15 lakhs, accounting entry, property, plant, equipment account debit, 15 lakhs to cash credit. This is the accounting treatment of the subsequent recognition. Very important thing which have been added by AS10, which is again a verbatim copy of A16. If the payment is beyond the normal credit term, then the total price minus the cash equivalent price is the interest. If say I'm supposed to pay about say 1 crore in 3 months time, but rather than paying 1 crore in 3 months time, I said that look, give me more time, and I said I'll pay after 1 year, and I end up paying 1 crore 20 lakhs. So 1 crore 20 is a total price. Cash equivalent price is about 1 crore, and the difference is interest. This is to be capitalized or not, depends on AS16 borrowing cost. If the machine is to be used immediately, then the interest is to be expensed out. If the equipment is going to be used for after the period of more than 1 year time, something like that, you capitalize. But in other words, it will not form part, whether it will form part of the equipment as per A16 or not depends on the usage of the equipment after the payment is made. Now this is again a new requirement added. Earlier revaluation was permitted, no denying, but now it is presented, it is projected that if you want to do, you can do it even regularly busy, even regularly also you can do that. Otherwise, earlier it was one of a time. So two models, either cost or revaluation. Now I have said that it is applied to the entire class, no cherry pick model, to be done under asset by asset, not block of asset, and no fixed revaluation. Third line is different model can be used for the different classes of the asset. Now I'll combine these two paragraphs. First is I'll tell you what are the classes of assets: land, building, equipment, and computers. They are known as the classes of assets. Now let us read the second paragraph. To be applied to entire class, no cherry pick model. To be done on asset by asset and not block of asset. Now they say that different models can be applied for different classes, but within the same class, entire items, all items to be covered, no cherry pick. So let me give you an example. You have a land for which you apply the revaluation model. For building, you apply the cost model. For equipment, you apply, say, fair value model. Sorry, revaluation model. And for computers, you apply the cost model. This is permissible. For land and equipment, you are applying the revaluation model. For cost, you are applying the building and computers, you are applying the cost model. That is permissible. But what is not permissible? I got 10 pieces of land and I got 100 equipment. So I must revalue all 10 pieces of land, and I must always revalue all 100 pieces of equipment. There I cannot be selective. There I don't have a cherry pick model. I have to value all my 10 pieces of land, not necessarily on the same day, maybe in a span of 2 months time, 1 month's time, 3 months time, but you keep on revaluation it. Idea is that you revalue all these 10 items in a reasonably permissible time. This is what I mean to say, that different model for different classes, but within the same class, no selection. Now, revaluation can be done in two ways: either eliminate the accumulated depreciation fully, or you gross it up. Friends, as I told you, revaluation is hardly done by any company, so I'm just skipping this. And I've given the example here. There are two methods. One is a net off method. Second is the grossing up method. So initially, basically, you remove the accumulated depreciation. As a result of it, accumulated depreciation will become zero, and even the cost will come down by that 55,000. And then you revalue the asset cost account debit, and revaluation reserve. Revaluation reserve will be recognized not in income statement. Revaluation of property, plant, equipment is not recognized in the income statement, but rather it is recognized in the reserves, okay, in the equity. And when you do the revaluation of property, plant, equipment upward, it results into deferred tax liability. It gives rise to deferred tax liability when an entity is revaluing property, plant, equipment upward. This is again accounting entry for the grossing up. Okay. And then treatment of the revaluation, it is to be done on asset by asset basis. It is to be done on asset by asset basis. If there was no earlier revaluation, if there was no earlier devaluation, it is straight upward revaluation. It is straight debit profit and loss account and credit the revaluation reserve account. If there was an earlier devaluation, then you first credit the profit and loss account, and then balance you credit to the revaluation reserve account. But in both the cases, whether there was the earlier devaluation or not, the debit will still be to the assets or the property, plant, equipment. Debit property assets, public property, plant, equipment, and credit revaluation if there was no devaluation, and if there was earlier devaluation, first you set off to the tune of earlier devaluation and then the balance to the revaluation reserve. Like this, devaluation, that means bringing the value down, is if there was no upward devaluation, straight we debit profit and loss account and credit the asset account. If there was an upward devaluation, only to the balance of revaluation reserve, it will be adjusted against revaluation reserve. Otherwise, it will be debited to profit and loss account. balance will be transferred to the profit and loss account. Then depreciation to be charged. I think here I need to explain you once again. If there was no upward revaluation, debit profit and loss account fully. If earlier upward revaluation, then debit revaluation reserve to the extent of the balance in the revaluation account, revaluation reserve account. And then I would say if the devaluation is more than the upward devaluation, the devaluation is done by say 5 lakhs, and there was balance in devaluation reserve to the tune of 2 lakhs. Devaluation is done by 5 lakhs. There was a balance in the revaluation reserve of 2 lakhs. So my accounting entry will be like this: debit revaluation reserve 2 lakhs, debit profit and loss account 3 lakhs, and credit the asset account, provided there was earlier revaluation. If there was no earlier revaluation and you're doing the devaluation for the first time or 5 lakhs rupees, entry will be debit profit and loss account and credit the asset account. But as I told you, hardly it happens. To be charged on a systematic basis, that is proportionately, maybe daily rest, weekly, monthly, monthly or half monthly depreciation. Separate identifiable parts are depreciated separately. There's a component accounting. It begins when the asset is ready to be used and not put to use, and it ceases when the asset is retired from the active use, or when the asset is derecognized, and the plant is depreciated even if it remains idle. This is a very important statement from the perspective of the depreciation conceptually. Even if the plant is not used, it is still to be classified as it is still to be depreciated. So even the idle plant is also to be depreciated. But there is one requirement here, and that is the requirement is that if the any item of property, plant, and equipment is not used, more so when it is capable of being used, it remains idle. Even if the idle plant is not used, it has to be depreciated. But the standard says that you should try and disclose this fact to the this fact in the notes to accounts, that XYZ plant is idle, is not being used, but still depreciated. Land and building are to be depreciated separately. The common mistake which normally small companies make is as under. They acquire land and building in some industrial development corporation, like Tamil Nadu Industrial Development Corporation, like Karnataka Industrial Development Corporation, and they buy the plot along with some structure. The mistake made by them is that whatever money they paid for this structure or the industrial unit, they fully depreciate. They don't segregate into land and building. I think one should take care of this and do that. Straight line method, diminishing balance method, and the unit of production method. Mostly straight line method one should use. That's the most easiest to comply with. Cost or the revalued amount minus the residual value is the depreciable amount. Depreciable amount divided by the useful life is the depreciable, that's the amount of depreciation. If my cost is 1 crore, residual value is 5 lakhs, then 95 lakhs is the depreciable amount. The useful life is 10 years. So 95 lakhs divided by 10 years is my amount of depreciation. This sentence must be there in your notes to accounts, and I think you must encourage the board to do that. And you must include this in the board meeting, in the agenda of board meeting, that management has reviewed useful life, residual value, and the method of depreciation. Changes therein are regarded as a change in an estimate, and they are hence accounted for prospectively. Now this is the derecognition. After this, I think Monica ji asked me, when do you need the break, sir? So I would say that this may take maybe another 5 or 10 minutes at the most, and at that point in time, maybe sir, I will request for a break of maybe 10 to 15 minutes, mostly because there are my relatives who come up. for the cake cutting and all this, and they want to travel about 25 kilometers away from here. So I'll beg for 10 to 15 minutes after this portion is over, after this standard is over. Is it okay, sir? Is it okay for the participant?
Noted, sir.
Yes, yes, yes. Yes, sir.
Thank you,
Most
sir.
welcome, sir. We are not, we are missing your cake cutting.
I will demonstrate it if you want. Okay. An asset is derecognized when the future, when it is useless, it is not going to get any benefits to the entity, and the gains and losses are recognized in the profit and loss. Say, for example, the carrying value of my property, plant, equipment is say 10 lakhs, and I am discarding it. So my entry is debit profit and loss account and credit property, plant, equipment. Now, compensation received from the third party, like insurance, is credited to profit and loss account and not credited to the cost or the balance in that particular property, plant, equipment. It doesn't make much difference whether you deduct from here, but this is the requirement of the standard. Very important, balance to the credit of revaluation reserve is to be transferred directly to retained earnings, and not to be transferred to profit and loss account. Compensation from impairment from third party is to be credited in the profit and loss account when it becomes receivable. Now, intervals in ready to use and put to use. Now, here is a difference. It is ready to use on 1st of January. It is put to use on 1st of April. It is ready to use on 1st of January, and it is put to use on 1st of April. Now, if the interval between the project is ready to commence or the commercial production, that means ready to use and put to use, and the date of the commercial production actually begins is too long, then all expenses incurred should be debited to profit and loss account, because conceptually, if an asset is ready to use, any expenditure incurred thereafter is not to be capitalized. Then, as if I requested for of your thing, this is the example of the notes to related to the property, plant, equipment. So friends, this is the first part, that's the AS10, and I'm willing to take the questions now. If participants have any questions on this, please let me know. Your comfort level is more important than my cake cutting. Friends, if you
We have
have any,
2 to 3 questions, sir. Maybe we'll take it up post the break session. So we'll have a break.
okay, all right. So I'll just try to take a break
Stop.
and try to take the break of 10 minutes, not more than 10 minutes, or okay, maximum it will be 15 minutes. Okay,
Noted,
sir,
sir. Noted.
please,
Noted,
with
sir.
your permission. Thank you, Ji. Thank you, sir. Sir, can you hear me?
Yes, sir. Can hear you,
And
sir.
now
So,
I need to please give me the give me the window for the authority for the sharing.
screen sharing, sir.
Uh,
So are we going to go for a presentation, or also shall we take some questions, if any?
we can take some questions. I don't mind, but let me first put my presentation of the second standard, the next standard, and then let me just bring it on the screen, and then I'll take the questions.
Okay, okay, okay. 1 minute, sir. Yes.
Now share screen is this.
It's already shared, so I
Let
can
me
see the screen. Thank you slide, actually.
yeah, yeah,
Okay.
I can, you can see, you know, here is revenue. Can you AS9?
Yes, yes, I can see AS9 slides, sir.
Okay,
So
fine. Now you can take the questions, sir.
actually, I need to share my screen. I take the rights back and I'll share my screen. Is my screen Excel sheet visible? If you click on that orange arrow, you can see my Excel sheet.
I can see the question: any litigation expense incurred in acquiring the asset, then whether any litigation expenses are incurred in acquiring immobile assets, sir, if non-company has depreciated asset. Okay, now let's go one by one. I believe question one is any yes, this is very good. This is very good. Allow me a minute. I will realign my screen. Okay. Any litigation expenses incurred in acquiring the asset, such expenditure should be taken in the cost of acquisition. Is it right? You are absolutely right. Such expenses are to be recognized as an expense because these are the acquisition costs. And if you're not defended, if you're not incurred these expenses, naturally you will not have got the asset. Whether any litigation expenses are incurred in acquiring the asset. So for question number 1 and 2 are the same one. Okay, the third one is, sir, if any non-company has depreciated an asset till now, not depreciated asset till now, as there is no legal obligation. Yes, like the just a minute, as there is no legal obligation, can the entity estimate the useful from the date and depreciate? Yes. Say for example, I am a partnership firm, and I have not, but now there is a non-corporate asset also, non-corporate entities also, you have to follow these certain standards depending on the level 1, level 2, or level 3. But let's presume that you are not you are not required to apply this standard, and now you've done. At the end of year 3, you decide to depreciate assets. So from this point onward, at that point of time, you should see what is the value of this thing, and then apply this, then estimate the useful life from this point in time, and then apply that charge the depreciation. Disposal of scrap on which GST is paid is shown as a sales turnover in the GST return, whereas the same is adjusted in the cost of construction of the balance sheet. How to explain the difference in the treatment in the income tax returns? Now you are, gentlemen, a very brilliant question, but I'm not a GST man. But let me tell you, on disposal of scrap, when the GST is paid and is shown as a turnover, so on scrap is shown as a turnover. Scrap. Which kind of scrap? Scrap is generated during the production in the normal course, or scrap during the construction stage. Now the gentleman or the lady who had asked this question, can you please be a little vocal about this question, please? Hello, because
Sir,
you
it is
have your first.
it is the scrap generated during the course of confection, and
Acha,
and
fine,
it is
fine.
not
I got it.
generated from the process.
Okay, now the question number, the second, just the your block above it, just second last block, disposal of scrap. Please come to that. Disposal of scrap on which GST is paid is shown as a sales turnover. You are absolutely right. Maybe requirement of the GST, and the same is adjusted in the cost of construction in the balance sheet. And how to explain the treatment in the income tax return? So you are connecting three things. One is the income tax, second is the accounting treatment, and third is the GST. Okay, now, sir, the income generated and expense incurred on the test, this is a different thing. So I'll just go to the disposal of scrap. as far as disposal of scrap is concerned, during the cost of construction, you will definitely reduce it from the cost of construction. And when it comes to the GST, you can say GST turnover as per the books of account is XYZ, say about 100 crores, and add scrap, which was been capitalized as per the AS10. So then your scrap will be, as far as GST is concerned, you will be showing your turnover inclusive of the scrap in your GST returns. And as far as the income tax is concerned, income tax also allows the, as far as income tax is concerned, during the construction stage, income tax does not say that you should treat this scrap as an income, because that's a requirement of the accounting standard. And then I think one should also look at the ICAI standards, income tax disclosure standards. Income generated and expenses incurred in the test run is what the accounting treatment is per AS10, whether to be adjusted with the cost of fixed asset or is debited to profit and loss account. Now, the second last question about the income generated and expenses incurred on a test run. I had given example that you incur about 10 lakhs rupees for acquisition of the raw material and the labor cost, and you receive 6 lakhs rupees on sale of the sample product. So only 4 lakhs is to be added to the cost of equipment, and nothing should be added to the, nothing should be taken to profit and loss account. So you will neither debit profit and loss account by 10 lakhs nor credit the scrap or the sale of samples in the profit and loss account, but you will take the difference of 10 lakhs and 4 lakhs, 10 lakhs and 6 lakhs into your capital of the capitalize the property plant equipment. You spend 10 lakhs, you receive 6 lakhs, balance 4 lakhs to be added to the cost of equipment, and nothing to be taken to profit and loss account. While acquiring the capital asset, there was a damage, insurance has been claimed, whether the claim is reduced from the capital asset or to profit and loss account. Very good question. Who has asked this question? I want him to say hello to me, please.
Let me just check, because if they're joined from a web browser or something, they won't be unmute themselves.
But very brilliant answer. So you know that capital asset, you bought it on as is where is basis, correct? And there was a damage, insurance has been claimed, whether the claim is reduced. Now, who had lodged the insurance complaint, you or the early one, correct? Because it was, if it was already damaged and then the insurance claim has been claimed, then naturally the seller will normally claim this damage from the insurance because it was done during his regime. But then if he's already aware of the fact that, look, this is the damage piece and you may claim the insurance, or he may say that I have already lodged a claim against the insurance company. Now, in that case, should it be reduced from the capital asset or to the profit and loss account? In my opinion, this should be reduced from the cost of equipment, because when you had bought this equipment, you were aware that it is a damaged one. You are also aware that either the claim will be lodged by him or me, but mostly the claim must have been lodged by him only, because insurance policy is taken vis-a-vis the company, vis-a-vis the entity, and not. So if you have lodged these, then also, regardless of whether they lodge, but normally in this case, when you bought it with the knowledge that it is a damage and he has claimed the insurance, he's lodged the insurance claim, and when you receive, it should reduce the cost of the capital, because it was already factored. It was already factored when you taken it. But a thing will become different when you bought a set and it was in a very good condition and then it will got damaged. So in that case, the damage will be credited to profit and loss account. So there's a lot of difference between when the damage has incurred. If it is already incurred, then it should be appropriated against the capital asset and not to be credited to profit and loss account. However, income tax will definitely charge, will levy the tax on this. It will, income tax will say that this is the money to be reduced from that, to be credited to profit and loss account.
I given back the rights to share it.
Okay. So this is the, okay, thank you, Ji. Now this standard AS9 is omnipresent. Now, friends, I must tell you something. How many of you are reading a very fundamental statement, very rudimentary statement? concerning the accounting standards. And that standard, that literature's name is Framework for Preparation and Presentation of the Financial Statements. Friends, we don't read it. We don't read it. Take my advice and try and read this statement, which is we are getting free of charge from the Institute of CA. Framework for Preparation, and also the preface to the accounting standard you must read. I know that you don't want to be a scholar, you don't want to be a faculty, but still you must read this statement. That defines the elements of financial statements. Now, what are the elements of financial statements? A, asset; B, liability; C, equity. These are the elements of the income statement. Sorry, balance sheet. Assets, liability, equity are the elements of balance sheet. Whereas income and expenses are the elements of income statement. Now, they say the income is an increases in economic benefits in an accounting year in the form of inflows to the entity, which will increase the assets, which will decrease the assets, and ultimately is going to increase the equity. But again, increase the equity in account of what, sir? From transactions other than relating to the contribution from the equity participants. That means your equity can go up even on the issue of share capital. That also means there's a inflow, but that is not considered as an income, correct? Because it is with the shareholders. Now here the increase, here the inflows or increase in assets or decrease in liability, which ultimately enhances the equity, but not with the transactions relating to the contribution from equity participants. They are known. So the last portion is not constituted as income, which everyone knows. In the definition of in income encompasses revenue and gain. Revenue happens from the ordinary activities. Gain is, so I put a gross. So when you sell the product which is being manufactured regularly, you're selling a one computer for say 1 lakh. You will not then say that 80 is my cost, so I'm going to show 20. No, gross is the revenue, and gain is the net. Gain is normally not covered for the ordinary activities. So let's take the example of a textile manufacturing company. And that textile manufacturing company, when it sells the equipment, which is not its normal production, the normal production is the fabrics, clothes. So when it sell the equipment, it is sold for say 1 crore, and the carrying value is 80 lakhs. So they will show 20 lakhs gain. If the carrying value is 1 crore, so if the carrying value is 1 crore, you're selling it for 80 lakhs, they're going to show the net loss. If the carrying value is 1 crore, you're selling it for 1 crore, 20 lakhs, the gain is 20 lakhs. So that is shown as the net. So basically sales, fees, rendering of services, these are in the ordinary course of activities. And if you see the item, these are marked in yellow shade, interest, royalty, and dividend. So technically they say income received by the entities from others for using the resources of the entity. That means I give my resource in terms of the capital, in terms of the loan. I give my resource in terms of my intangible assets, franchise right. I give my resource in terms of the investment in share capital, and I get either interest, royalty, or dividend. So these are again forming part of your revenue, and we'll see under what circumstances how they are being accounted for. Now this AS9 is not applicable to the revenue from the construction contract. For that, AS11 is applicable. Revenue from hire purchase, lease agreements, revenue from the government grants, other similar subsidies, and insurance. Naturally, these are not covered under the AS9. Now, basically, revenue is gross inflow of economic benefits in its own account. Very important, in its own accounts. That means if you received money on account of GST, it is not your revenue, because it's not the money which you have received on your behalf. You have received this money on behalf of someone else, and that is what? The government. Does the GST, this include GST, VAT, sales tax? VAT is still applicable in some cases, like in case of petrol and diesel and in case of liquors, as this does not result in the increase in equity. So very important, you should go to the definition which say that any inflow increases in assets or decreases in liability, which eventually increases the equity other than from the transaction with the equity owners in their capacity as the owners. Correct? So this is not going to increase in your equity, and hence it is not to be considered as a part of revenue. What do you mean by it is? GST, VAT, or any other taxes levied by the government. It results in increase in equity other than the contribution and arising in the ordinary course of activities, sale of goods and services. Even services are considered as a part of your revenue. Very important. Now, thereafter, later on, we'll see that it should be net of rebates, trade discount, volume discount. Now we also have something called cash discount, right, sir? So we have two types of discounts: A related to the trade oblique the volume, and B related to the payment of cash. So, my dear friends, dear organizers, I'm putting this question to your forum and to all my dear participants. What should be the treatment, or let me rephrase, the treatment of volume discount, trade discount on the one hand, and on the other hand, cash discount. So we'll say A discount, B type of discount. Will there be any difference in the accounting treatment or no? Would anyone like to answer this question, please? Hello. So you can always raise your hand, okay, and let the management know that you'd like to participating or not. Hello?
Sir, as regards the trade discount, it is to be
Yeah.
reduced from the sales turnover. As regards the
Okay.
cash discount, it is to be debited in the P&L account as the expenses related to marketing.
Fantastic. Can I know your name, please?
I am Nagarajan from Trichy.
Mr. Nagarajan, Namaskar ji. Your answer is
Yeah,
absolutely
Namaskar
correct.
ji. We are senior
Namaskar.
ji. Yeah.
So Computer ji is giving you 10,000 for Pehla Padao, for first Padao.
Okay. Thank you.
Nagarajan sir
Thank you.
is won the first prize, 10,000.
Okay.
Okay.
Thank you.
Thank you. Very good answer. Very good. I like participation. Very good, Mr. Nagarajan.
Okay. Yeah. Okay, sir.
To conclude, Mr. Nagarajan's answer, and very correct answer, compliments to him. Trade discount and volume discount are to be reduced from the gross value of the sale. So if I sold something for 10 lakhs and I give them the trade discount, that since you cross certain milestones, I am giving you a discount of 50,000. So this sales will be 10 lakhs minus 50,000. Now this will not be shown on the face of the income statement. You will not present it like, look, this is my 10 lakhs, this is my trade discount, out column is 9 lakh 50,000. No, like that. You will straightway show revenue 9 lakh 50,000. And thereafter, when he pays cash for the prompt payment, that discount will be debited in the profit and loss account, but not in it will not be appropriated against the sales. Very good answer. Is a gross inflow of cash, receivables, or the residing in the course of the ordinary activities of the enterprise from the sale of goods, rendering of services, and from use by others of enterprise resources yielding interest, royalty, and dividend. This is the third category, which was in the yellow shade. Now, as far as services are concerned, there are two ways of recognizing the services. The standard permits two methods of recognizing the revenue from services. A, completed service. B, proportionate. It is same like the construction contract. AS 11 allows two types of method, completed and proportionate. As the name indicates, in the first one, the revenue is recognized only when the services are completed. fully. Till such time you'll show as a work in progress. You'll not recognize the revenue. Now, you got a contract for rendering some services, say installation of an equipment. You are not a supplier, but it is supplied by someone else. And you have to install this equipment. Again, you are not a supplier of the equipment. A third party has acquired the company. Your customer has acquired equipment from third party, and you are asked to install it. It's going to take about 6 months' time. The problem arises when it covers the cutoff period. If the contract is received on 1st of April for a financial year 31st March 2000, for the financial year 31st March, no questions arises because within 6 months you are going to recognize the revenue. It does not interfere with any accounting year. There's no overlapping of accounting. But suppose the contract is received on 1st of January and it's going to take 6 months time to complete. And by March, the work is done, say 50%, 60% or not completed. You will not recognize the revenue. You'll debit it to the construction work in progress or some kind of a work in progress. But you receive some funds from the customers. So these funds are to be treated as a liability, advance from the customer. And only when at the end of month 6, when your work is complete and services have been installed 100%, you will recognize the revenue from services. And that's why any sum which is received during this course of servicing, during the course of rendering of services, are to be treated as a liability. And the second one is a proportionate completion method, in which the revenue is recognized in the profit and loss account in the proportionate method. And there the choice is either some valuation or some certification by a third party engineers or a third party agency, or maybe based on the cost incurred on the project. Suppose the cost CTC, cost to be incurred, cost to complete is say about 1 crore. You have spent 30 lakhs. Cost is 1 crore. You spent 30 lakhs. You recognize revenue to the tune of 30% and expenses also to the tune of 30%. So you'll see receivables 30 lakhs, and so receivables will be naturally more than 30 lakhs, correct? Because that will be it will also include the estimated profit. So cost of completion is 1 crore, you spend 30 lakhs, and this contract is for 1 crore 50 lakhs. The consideration of contract is 1 crore 50 lakhs. Cost to complete estimated is 1 crore, and you have spent 30 lakhs, so 30%. So cost of construction is 30%. Revenue is 30% of 1 crore 50 lakhs, which is 45 lakhs. So your profit naturally is 15 lakhs. This is how it is recognized. But here, suppose, Mr. Nagarajan, I feel like talking to you once again. Mr. Nagarajan, can I call you back? Can I ask you to come on? Can you please come live?
Yes, sir. I'm online.
You're online, Mr. Nagarajan. Mr. Nagarajan,
Yeah.
we invite you on the hot seat. You're invited to the hot seat, Mr. Nagarajan. Now the second question goes to you for 20,000 rupees. Second stage.
I will try, sir. I will try.
Okay. You can also call a phone a friend, right, sir? All right. So you have completed 30%, and you're going to recognize revenue of 45 lakhs, which is 30% of 1 crore 50,000 rupees, 1 crore 50 lakhs. But you raise the invoice on him of 50 lakhs. You raise the invoice of him on 50 lakhs. Whereas actually you should recognize the revenue of 45 lakhs being 30% of that.
Okay.
A, have you done this right? B, wrong.
Pardon?
Is this a correct? I mean, suppose you raise a, and let me repeat this question once again.
Okay. Revenue recognition reaches up to 45 lakhs, whereas the invoice is raised on 50 lakhs from the customer.
Absolutely correct. So how much you recognize as revenue? A 45 lakhs, B 50 lakhs.
Whichever is higher, sir.
Whichever is higher. Would you like
Yeah.
to take advice from your friends, or would you like to
No,
take call of the public?
no, sir. No, not reachable.
Not reachable. Answer
Yeah, I
is
will.
answer is you can recognize revenue only to the tune of 45 lakhs rupees only.
I see.
The progress bill or the any other invoices raised by you has got no relevance for the recognition of revenue under the proportionate completion method.
Okay.
Okay, sir. Hello. I'll
Okay,
do
that is
one thing,
okay.
Mr. Nagraj. Mr. Nagraj,
Hmm.
since you
Hmm.
have become a very good participant, I
Okay.
promise you one thing for all your colleagues, not just for you. Tomorrow, by
Hmm.
this time, you will have
Hmm.
something called journal entries and ledger accounts and accounting treatment of proportionate completion method of
Yeah, yeah. Yes.
services.
Yes, Savan. Yeah.
Okay.
Hmm.
So I will then give you the contract, like it's same like the construction contract.
Yeah, yeah. Yes, Savan. Yeah.
A7, A7. Sorry, it is not A11, it is A7. Correct, sir? So for
Yeah.
you, this is a gift by me to you, okay, and to all
Okay.
your colleagues. To all your
Okay.
colleagues
Thank
from.
you.
Okay, now tell me, all
Thank
of
you.
you are from the Chennai,
I am in Trichy.
Trichy. So
Yeah,
basically,
yeah.
you are all Tamilians, right?
Yeah, yeah.
So can I
Not
ask you a question? Eppadi sukam?
நல்லா இருக்கும் சார்.
Ah, I will answer. If you ask me eppadi sukam, I'll say nalla sukam.
சார் உங்க பர்த்டே செலிப்ரேஷன் கிராண்ட் சன் கிராண்ட் டாட்டர்ஸோட என்ஜாய் பண்ணீங்களா?
Ah, my grandson was there. My mom is there. She's 86 years old.
Yeah, yeah.
They all blessed. And I completed today 63 years.
Pardon?
Today I completed 63 years.
Oh, 63. Okay.
Yeah, I'm
You
embarking on
you seems to
64
be young.
years.
Okay. You
God
seems
has
to
been
be
very
young.
kind,
Yeah.
sir. God has been very
Yeah,
kind to
yeah.
me. Very kind to
Okay,
me.
sir.
So, Mr. Nagarajan, you brought life to this session. You brought life to this session, right?
Yeah, 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 yeah. Let it be interactive. That is what we also want.
Absolutely correct. I want this to be interactive, and you helped me a lot.
Yeah, yeah.
Thank you.
Yeah, yeah, yeah. Thank you, sir. Okay.
Thank you, Mr. Nagaraj, please.
Okay. Thank you. Welcome, Ji.
Yeah. So, how the revenue is measured? Not at the fair value. Under the index, it is at fair value. Revenue is measured by the charges made to the customers or the client or the goods and services entered by them, but basically it's a cost and the whatever amount you're going to receive from them, not the cost, but not at all by the fair value. Because when it comes to the fair value, I'll give an example. The difference between the AS and Ind AS. Now we have to hear me out very carefully. First, I give the example of AS. I'm selling an equipment for 10 lakhs. But along with that, I'm giving you a package. Look, you pay me 10 lakhs, but you also will get 3 years services free of charge. And that will cost me, the supplier, 20,000 rupees per annum. So for 3 services, it will cost me 60,000. Whereas if you go to market, if you don't avail of these services from me, which is free of charge, you will have to pay 25,000 rupees per year. So for customers' point of view, it is a saving of 75,000 rupees. For me, it is a cost of 60,000. Let's not go into that. But I will still show my revenue at 10 lakhs rupees under the AS. I'll not split into two parts. Friends, under Ind AS 115, the standard which deals with revenue from contract with customers. Now, this was the case of the AS, which is the non-Ind AS company. Your entry is plain vanilla. Bank account debit 10 lakhs. Forget about GST. GST is net of that. And revenue is 10 lakhs. Sorry. And next 3 years time, when I incur the cost of services, I will say my service cost to customer A debit to profit loss account, no revenue. So it's a clear loss to me. Fine. But I have agreed for it because I want to sell it. When I give this as a package that you avail of 3 years services free of charge, I'm still charging 10 lakhs rupees only. This customer will be inclined to buy. Come to Ind AS. Ind AS says that, look, there are two performance obligations here. A, your merchandise, your equipment, or the car. And B, your services, 3 years services, which you had agreed to give free of cost. So what Ind AS says? 10 lakhs plus 25,000, 25,000, 25,000. So 10 lakhs 75,000. That should be your actual revenue. But since you sold it for 10 lakhs rupees, then you proportionately allocate this 10 lakhs rupees over the cost of equipment and services for 3 years time. Because under Ind AS, it is considered as a separate performance obligation. It's split into two parts. Don't bring GST. GST you have to pay on 10 lakhs only. But for accounting, this will be less than 10 lakhs. So your revenue will be, your entry will be like this: bank account debit 10 lakhs. Hypothetically, the proportionate value of this 10 lakhs is say 9 lakh 75,000, 9 lakh 60,000 proportionate value. So bank account debit 10 lakhs. Revenue from sale of vehicle or the equipment is 9 lakh 60,000. And 40,000 is deferred revenue. 40,000 is deferred revenue. This would have been the case had this transaction been under the Ind AS. And that's what we call at fair value. But this is not done under the AS because they want accounting standard to be as simple as possible, as easy to follow. And that's why they have not brought in that concept here. Another example, I sold an equipment for 10 lakhs. My credit period is 3 months time. So he can pay me in 3 months time 10 lakhs rupees without paying an extra cost. But as against that, I give him the credit period of more than 12 months, say 15 months. My nominal value would have been 10 lakhs. I gave him an offer that you pay me after 15 months, and that is say 12 lakhs. Normal price 10 lakhs. Deferred payment with a credit period more than 1 year, that is 15 months, is 12 lakhs. So now they say that, friend, you have not sold equipment for 12 lakhs. You have actually financed it. Yes, so there is effective financing. So in that case, my dear friend, had this been an Ind AS, it would have to be split into two parts: 10 lakhs and 2 lakhs. 2 lakhs interest, 10 lakhs merchandise. But now let us talk about AS. You'll ask me, Mr. Nagaraj will ask me, hey, Mr. Desai, we asked you to dealt on the AS, not in AS. I agree with you. So under AS 9, you sold an equipment on a credit period of 15 months for 12 lakhs. Entire 12 lakhs will be treated as a revenue. No need to split, no need to fair value. What I have done under Ind AS by splitting into two, I measured the revenue at fair value, which is not required in AS, which is not required in the AS. Got my point, sir? Now, in an agency relationship, revenue is the amount of the commission and not the gross inflow of the receivable, which you all know, the parent and agent. Parent and agent. Sorry, principal and agent. I'm so sorry. Principal and agent. Sorry. So obviously, agent is entitled only for the commission and not for anything else. Please. Next, the water, please. Agent is accounting is is entitled only for one thing, and that is the commission. So if I sold a ticket for 1 lakh, I'm entitled to 10% commission. So what I'll do, sir, I'll recognize my income only at 10,000 and not 1 lakh. This is the common principle, nothing great about it. But they say, so technically it also means that you have collected this money on behalf of others. So when I sold an equipment, it is an airline ticket for 1 lakh. Actually, I'm entitled for 10,000. So 90,000 I've collected for others. So that's what the standards say, that if you receive, if you recover something on behalf of others, then it is not to be treated as a revenue. Now they say all conditions are to be complied with. The entity has transferred. Friends, I would suggest one more thing. We tend to take something for right and granted. I am not an exception to this, including me. I am not an exception, as I told you. We tend to take ourselves for right and granted. Oh, ace nine, I know it here. You know, I was a ranker in those days, and I passed it like this. I passed in this final C in one first attempt. I don't need to read it. No. The more you read, the more you gain. The more you read, the more you realize what you were not knowing till now. Don't feel ashamed of reading accounting standards. I know a very renowned income tax chartered accountant, Mr. B.K. Khare from Mumbai. I would say late Mr. B.K. Khare from Mumbai. Back in 87, when I went to seek an opinion from him for income tax, he called me on his table and this, Mr. Desai, there is one set of income tax act and rules. It is for you and one for me. I said, sir, you need to read this. You're an expert. He said, let us read the section together. So like this, friends, howsoever senior you are, don't feel ashamed of reading the act, reading the standard, reading the interpretation, reading the government notifications afresh. No, don't feel ashamed of it. Friends, this is my 39th year of practice. I'm in practice since 1983. I started in August 83. 39th year, and very soon I'm going to be in 40th year. I don't feel ashamed of reading the standards afresh when any of my colleague article or any of my partner or any of my client comes for this. When they talk about Caro, I said, let me read the Caro with you. Let me read Caro with Caro guidance note. Got my point, sir? Please do that. Read the standards. Now here I'll give you a tip as to how it is going to help. You know all that non-corporate entities and the small and medium company SMCs threshold limits have been increased from 50 crore to 250 crore rupees. And now as a result of which you become the smaller company or the SME or SMC. You read the I'll also reproduce it. So Mr. Nagraj, first I'm going to give the proportionate service contract accounting tomorrow, and second I'm going to discuss with you the one notification which was there in August 21 about the accounting standards. The last para they added, if a company becomes SMC, say in year 2022, for next 2 years, it cannot claim exemption of SMC. If a company has become SMC for the year during the year financial year 21-22 because of the enhanced limit and all this, for next 2 years, it cannot claim this exemption as a SMC company. Now you will be carried away and mesmerized by the fact that look, my company's turnover is 200 crores, so I should be SMC. I should not be able to claim this benefit, but I'll share this with you friends with a specific emphasis that read this paragraph. Okay. So point is, you do read the government notifications for the MCA for the corporate, and a normal standard for the other than the companies read the normal standard. For MCA, you to read the same standard, but with the notification, any additional requirements are there. For those MCA for listed for the private companies, CARO is important. Sir. CARO guidance note. You read the guidance notes of the issued by the ICAI. Believe me, you yourself will realize that how ignorant you were about so many entities, so many aspects of the accounting standards. So I request, a humble request, do read standards yourselves. Don't be at the mercy of your partners or your associates or even the articles. Okay. Now, the transfer of risk and rewards, which normally happens with the along with the physical delivery. And very important, the entity has neither retained any continuing or the managerial involvement. And for this para, I done some research and got some incidents examples as to what do you mean by retaining the effective control. That means if you retain the effective control, you should not recognize the revenue. Amount of the revenue can be measured reliably, and the cost can be measured reliably. This is again very important thing, sir. So when you read the framework, they have given the recognition criteria. They have given the recognition criteria of the revenue, whereby they say that, and you find always two conditions: whether the revenue can be measured reliably and whether the economic benefits associated with the transaction will flow to the entity. I'm exporting one good today. I shipped it at 6 p.m. And the condition is that FOB destination. Exported something. Free on board destination. And I have sent it to Ukraine. I've exported to Ukraine. I know that and say incidentally, I mean, I don't remember the date. Say let us, it was some date in March. Say 3rd March. 3rd March I exported goods. It was loaded on the carrier. Condition is FOB destination. That means I will recognize the revenue when it reaches the destination. Had it be FOB shipping point, I would have recognized the revenue today only. But I'm giving you another twist. 6 p.m. I loaded everything, bill of lading, everything was done. Agent said, sir, export is over. Now nothing pending. Fine. Next day morning when I get up, I find news. Russia attacked Ukraine. I know that this money I'm not going to realize. So I should not recognize the revenue at all. Okay, my dear friend. Now let us take another example. I have already shipped the goods in month of February. There it was very much peaceful. No talk of only Putin and Biden. They were meeting. They were just doing some time pass. And they were finding out some strategy as to what to do, what you should say, what I should say, what I should do, what you should not do. Things were looking very simple. I had exported on 3rd of February. On that day, it was clear that I will get this money. So I should have recognized the revenue on 3rd of February. And on the 3rd of March, the things have worsened. I should treat this as a provision for bad debts under the AS. Under Ind AS, it is expected credit loss. The point is, when you realize about the collectivity, when the doubt was there about the collectivity, on the day of export or after that. In the second case, in the first case, on the day of export was 3rd March and 4th March AM, I get the news. I should not recognize the revenue at all. I should treat this as my inventory. but net of profit. Suppose my billing was 1 crore 20 lakhs and cost was 1 crore only. I should value my inventory at 1 crore rupees only, or maybe cost or NRV, whichever is lesser. Don't use the word cost of market value, cost or NRV, whichever is lower. So no revenue will be recognized, it will be as inventory. In the first case, I'll recognize as the sale and account make it for provision for the bad debts. Friends, if you allow me to go back to AS10, if you allow me to go to back AS10, close this window and please go to AS10, because there is something which I should have mentioned. There are changes in division 2, 1, 2 and 3. Changes in division 1, 2 and 3, which is the format of the balance sheet and profit and loss account of schedule 3 to the Companies Act. They were introduced in March 21, but made effective for the financial year 21-22. So there is an additional requirement on property, plant, equipment for the revaluation, for the title deeds, and whether they have been kept properly or not in the CARO. In the CARO and in this division 1 and 2 plus in CARO also. So be careful about that. If time permits and if you allow me to come back to you with division 1 and CARO, I got a very good presentation where I'll show you the requirement of division 1 schedule 3 coupled with requirement of CARO. For example, when it comes to property, plant, equipment, I will immediately show you and tell you this is required by paragraph 1A, 1B, paragraph 3 into bracket 1, A, B, C, D, as the case may be, about the title deeds, about the revaluation, and about whether they have been kept properly or not. It's a very good presentation, and if time permits some other time, or if you invite me, I will take this. I will be more than happy to take this session where I have blend the requirement of division 1, 2, 3 with the CARO. So you have a quick reference. So it is this paragraph. If it is this line item, this paragraph. If it is this line item, this paragraph, like that. And when it comes to the revenue recognition, it talks about the datas, trade receivables, the correct word, and trade payables for the goods acquired. You have to give the aging analysis. You have to give whether they are disputed or not when it comes to the presentation of the trade receivables and trade payables. You have to give whether they are disputed or not, then you give the aging analysis, 6 months, 6 months to 1 year, 1 year to 2 years, and more than 3 years like that. So be careful about those things also. So this paragraph you'll find almost everywhere. Last 2 items. Amount of the revenue can be measured reliably, and economic resources are expected to flow to the entity. That is nothing but the entity should be entitled to get money, and even the cost can be measured reliably. So these are given in the framework. You must read this. No significant uncertainty exists regarding the amount of the consideration that will be derived from the sale of goods. So on 3rd February, there was no significant uncertainty, and hence I had recognized the revenue. Whereas on 3rd March, there is uncertainty about amount of the consideration that the entity will be entitled to. So on 3rd March, I don't recognize revenue. On 2nd February, on 3rd February, I recognize the revenue. Now, services completed, proportionate. As I told you, that such form should be regarded as being achieved when no significant uncertainty exists. That's fine. That is always there, whether it is service or this thing. But income from use of assets, that is the interest on the accrual basis. When it comes to Ind AS, they use the word effective interest rate method. When it comes to the royalty, it all depends on the agreements as to when the income will accrue and what rate, whether it is 10% of net or 10% of gross or what. Dividend naturally when you are entitled to receive when the company announces it. Then I'm dwelling upon the risk and reward assessment of the, basically friends, everything depends on the terms and conditions by and between the parties. For simple ordinary things, I bought this iPhone or the whatever machine or whatever cell, I took it from you, I took the delivery, I paid the money, done, finito, nothing more. Installation of AC, all done, no issue. But then now the question arises that installation of an equipment. If the machine installation is intricate, then normally the person, the buyer would put a condition, look, I'll pay you only after the successful test run. Only after the successful test run. But you already supplied equipment to the client, to the customer. It is gone, it is left from your warehouse. And you received some money also from the customer. When you receive money from the customer and it is still not, the test run is not completed, you not recognize the revenue, so the amount received is to be treated as a liability. Here I'll give you one more tip, and that is from the company's exact point of view. For the companies, if you received advance from the customer and you've not supplied goods within 365 days, then 365 plus 15, so within, at the end of 380th day, you should return this money to the customer. If you not repaid this, it will be treated as a deemed deposit under section 673 of the Companies Act. Be careful about it. Just refer section 73 of the Companies Act, read with the rules. Rules are given in chapter 5 of the Companies Act. Just very good tip, because this, if you don't take care, it will be very, very devastating. Section 73 of the Companies Act, read with chapter 5, rules of deposits. Okay, if this, so it all depends on the terms and conditions. So till such time the machine is installed and till such time the successful test run is not performed, the seller will not recognize revenue from the sale. It will show as an advance receipt. It will continue to show this as an inventory. Now here AS2 comes into play. Here Caro requirement will come into the play. Whether inventory has been taken correctly by the not, because inventory is not taken by the auditor. Auditor never counts. Auditors observe the inventory. Sorry, sir. Auditor never counts inventory. He just observes whether inventory has been counted correctly or not, taken correctly or not, accounted for correctly or not. So AS2 equaling come into the play, that in this case you'll say inventory lying at the customer's premises. This should also disclose in the notes to accounts. So point is, it all depends on agreement between the parties. Now coming back to that thing, that FOB shipping point and FOB destination. FOB shipping means I load the goods on the carrier on 25th of April. So I recognize this as income on 25th of April. It reaches the destination on 25th of May, but I recognize this income on the 25th of April. Why? It is a FOB shipping point. So the moment I load on my ship carrier here, I recognize my revenue. The buyer will recognize the purchases even if they are on the transit. So buyer will account for goods in transit. I will reduce from my inventory. FOB destination. I am loading goods on 25th April. The goods are reaching the destination on 25th of May. till 25th of May, it is for me goods in transit going. And I recognize income only on 25th of May. The importer there in the FOB destination will recognize the income on 25th of May only and not on 25th of April. Then there are many issues as to what happens. Now these are very important, sir. And more so in the international transactions. Because the title decides who should bear the risk and reward. We always keep on talking about the risk and reward. Now what is the risk? The risk is fire. If something goes wrong, then who will be responsible for that? The one who is owner. So there is more to it than me to I. It's not just recognition of revenue and debit or crediting of profit loss account and reducing my inventory. No, it is also important that who will be responsible for the losses. If it is FOB shipping point, that means I loaded on the carrier on 25th of April. On 27th, there was some sea storm and all goods are gutted, lost. I'm not responsible for the losses. The reason being, I sold it. Title has passed as per the FOB shipping point. Had it been FOB destination, my risk is extended till it is accepted by the buyer. So this is where it's very important. Then sometimes if the substance of the arrangement is such that the seller retains the risk and reward ownership, even if legal title is transferred, the transaction is the financing agreement and does not give rise to the revenue. I have given an example at the end of it. What if the consideration is issued but revenue cannot be recognized? Recognize the money as a liability and no adjustment is made in the inventory. My title is not passed. My revenue is not considered. My revenue is not recognized. I have received the money, recognized as a liability. My inventory will be same. It will not be reduced. And that's what I mean to say. And no adjustment is made in the inventory. Then, sorry, this is up and down. Instances where the entity retains a significant risk and reward. When the entity retains the obligation for unsatisfactory performance, not covered by the normal warranty. That means normal warranty is this: I buy this, finish. Abnormal warranty is satisfaction to the customer. So I still retain the significant risk and reward. When the receipt of revenue from the particular sale is contingent on derivatives of the revenue by the So it says that when I'm selling it to you, but you in turn when sell it to someone else, I'll recognize the revenue. That is known as a contingent on some other derivative. When the goods are shipped subject to installation and the installation is a significant part of the contract which has not been completed, it still retains the significant risk. And that means you are not recognizing the revenue. When the buyer has a right to rescind, that means cancel the purchase for a reason specified in the sales contract, and the entity is certain that about the probability of return. In that case, you will not recognize the revenue because the history says. Friends, now right to return. I'm making these notes, Mr. Nagarajan, for you and your colleagues. I give some example here that when you buy goods from the online portals, they say you can return the goods in a week's time. You are entitled to return the goods in a week's time. And the company has sold merchandise on 1st of April. And by 7th of April, or say by 10 days, 10th of April, the buyer is entitled to return the goods. Mr. Nagaraj, are you there, sir? Or have you gone for the dinner?
No, I am here.
You are there. Achha, what time normally you dinner, Mr. Nagaraj?
9:30.
9:30. What is there for dinner today?
I do not know.
You do not know.
I'm
There's
with you.
suspense, right?
I am with you. I am with you. So I do not know.
You do not know. That's fine. That's fine.
Yeah,
Okay,
yeah.
okay. Mr. Nagaraj, when the Amazon sales goods on with the
Alright.
condition in 10 days you can return the goods, do you mean to say Amazon will not recognize revenue for next 10 days time?
Okay. Sir, I don't
Or
get
when
you.
you buy something, or when you buy something from the mall, okay,
Okay.
and it says that you can return the goods within 7 days time, do you think that the
Okay.
mall will not recognize revenue for 7 days?
No, they will take it as a revenue and subject to the condition it will be taken as sales return if it is being returned.
Then that is when the sales is returned, it is fine. But
Okay.
till 6 time, so till 7 days or 10 days, what will they do, sir?
Alright.
Till next 7 days or 10 days, what will they do, sir?
It will be reduced from their stock and it will be taken as sales.
It's taken as a sales. Okay. Now
Yeah.
there is no specific requirement under the AS that you should estimate something, but under Ind AS, there is a requirement that the management will estimate
Okay.
that out of 100 goods sold, out of 100 people's, out of 100 customers, 2 customers are returning. Or you can say,
Okay.
in other words, 2% of the revenue, 2% of the goods are being returned. So they will make the provision for the goods return
Okay.
for next 10 days or 7 days, right, sir?
Okay. Okay.
And then they will pass an entry. So, Mr. Nagraj, for you, I will
Ah,
also prepare one more journal entries in such cases.
yeah.
Okay?
Yeah.
Okay, sir. Now
Yeah.
give me a very big smile, sir.
Yeah. Yeah.
Okay?
Okay.
Fine. So when I say for Mr. Nagraj, it is meant for his colleagues also.
Okay. Okay.
All
Thank you.
participants. Okay? Thank you.
Okay.
Revenue is
Thank you.
recognized when it's probable that economic benefit will flow to the entity. Now, Mr. Nagraj, kindly mute yourself, please.
Okay.
So I give the example that when it is probable that you will receive the money, and after that it becomes not receivable, you provide for the bandits. But you recognize revenue when it is certain that you will get the money. When it is not certain, foreign country, Kuwait, Iran, and now we have Ukraine, don't recognize the revenue. Matching concept, you should recognize the cost of that particular asset or particular revenue. Cost of goods sold, warranty, etc. are even recognized. Revenue and expenses that relate to the same transaction or the other event are recognized simultaneously, immediately. So when I sold the goods and if there's a warranty to be provided, I recognize the warranty now only. So what I do, expenses for warranty account debit to provision of warranty. And this is based on the empirical evidences. I know that when I sell goods of ₹1 crore, at least 2 lakhs I have to provide for the warranty. So I recognize revenue of 2 crore rupees or 1 crore rupees. That's fine. Second, simultaneously, I also pass the entry for the cost of goods sold by reduction from the inventory. God, sorry. And the third thing, I make provision for the warranty. So I make provision for the warranty to the tune of 2 lakhs rupees. Warranty expenses account debit to provision for warranty. So this is how I pass an entry. Just a minute, please. So in year one, I made a provision for warranty. So am I visible now? Okay. In the year one, when I sell the goods, I make provision for 2 lakhs as warranty. In year two, I realize that this warranty is not required because the expenses of 2 lakhs is not required. I can do it with only 50,000 because of the improved technology. Sir, I'm going beyond revenue also. I'm going to provisions, liability, and contingent assets, contingent liability. I'm repeating this example. I sold goods worth ₹1 crore. 2% is the warranty. I made a provision of warranty account debit in the same year in which I sold the goods and credit the provision for warranty. In year 2, I realized that when the goods come for the rechecking or something like that, I don't need to spend 2 lakhs rupees. I may spend just 50,000. So I think I then realized, okay, this provision of 2 lakhs is not required. It can be done only with 50,000. So in that case, my dear friends, what I'll do, I will debit provision for warranty by 1,50,000 and I will credit profit and loss account by 1,50,000 in the year 2 and I will not restate year 1 account. When the provision is being revisited, when the provision is revisited in the subsequent year, entry past is prospectively and not retrospectively. There the matching concept will not apply. What is the fundamental principle for this? The fundamental principle governing this accounting treatment is the accounting policies. Because warranty is an estimate. Warranty is an estimate. Any changes in the estimate are accounted for prospectively and not retrospectively. You getting my point? It is not a part of this, but still I feel like explaining this once again to you. Mr. Computer, what happens to you? Okay. Include any amount collected on his own account. So revenue exclude volume, rebate, trade discount, amount on behalf of others such as the GST, maybe VAT in case of the petrol and all this, or the liquor, amount collected in the capacity of an agent on behalf of principal. And because and then this question that what happens to cash discount, we've discussed. It will be not deducted from the revenue, but it will be debited to profit and loss account. Now, this is the principal and agent guidelines. I don't want to debate much here. It is just mentioned as an additional this thing that who are agent and who are principal. In a nutshell, the one who bears the risk and rewards are principals. The one who is not related, not taking the risk and reward are the agents. Airline agents, whether the tickets are sold or not sold, they're not concerned. They are only concerned about that commission. Right? And who decides, who takes the call of deciding the price, who is responsible for any damages, goods, and if the flight gets delayed, it's not the agent who is responsible. Of course, they'll call up the agent only. Flight is not on time. You're not giving me money. I'll get full money. They will just bombard the agent, but agents will say, "You go and speak to the airline." That's it. So these are the guidelines for the deciding as to who is principal and who is the agent. And again, does not have the exposure to the significant risk. This is just an extra material for you. And I don't need to explain it in so many words. Now, this is the recognition criteria for the services. Outcome reliably measured. The revenue is recognized by reference to the stage of completion, percentage completion method. When the outcome is not estimated reliably, revenue is recognized to the tune of cost incurred and to the extent of recoverable expenses incurred. You have got a contract for service and hardly 5% progress is made. And even that, there are two situations. This you can recover from the customers and you cannot recover from the customer. Progress is 5%. First case, you can recover from the customer, recognize expense to the tune of 5%, recognize revenue to the tune of 5%. No loss, no profit. Second situation, customers say that till such time you complete 20% of the project, till such time you completed 25%, 20% of the project, I am not going to pay you any money. You have no right to collect this money. So up to 20% of the project, whatever I incurred, I don't recognize the revenue. This is the criteria they say. Secondly, A7, I had wrongly said by mistake AS11. Sorry about that. Once again, as per AS7, it's also say that when the entity is expected to incur cost for the completion of the project, they call it CTC, cost to complete. You should recognize the losses immediately, regardless of stage of construction. Okay, you can see stages can be measured reliably. The cost incurred and cost to complete can be measured reliably. These are the recognition criteria given in the standard. Now, these are the guidelines as to when you can make the reliable estimates of the progress of the services. Revenue to be recognized on the basis of the stages of completion, also referred to as the percentage completion. Okay. And how the stage of completion survey of the work completed, maybe some kind of an architect, third-party agency, or the cost. Gentlemen, can you please mute yourself? Progress payment and advances received from the customer do not affect the method. So this is very important. Any amount received.
Kindly unmute yourself, sir. You're like muted. Just kindly unmute yourself, sir. Sir, am I audible to you, sir?
Okay. Now they say this, sir, that when the progress cannot be measured reliably, the recognized revenue shall be only to the extent of the expenses recognized are recoverable. In other words, no gain. As I told you, if the progress cannot be measured reliably, then you recognize revenue to the tune of cost only. In other words, don't recognize gains and losses. Where revenue is 100, expenses is 100. Then about there's one disclosure requirement, I think, and this is again given in the delivery when is delayed at the request of the buyer, and buyer takes the title and accepts the billing also. This is also known as a bill and hold. So you asked a customer to supply you 10,000 dishes, dish antenna. You placed the order today. You made a payment today also. But you tell them that, look, I need this equipment or the merchandise in next 3 months time. So for next 3 months time, you will pick up this, but the condition is that it will not be recognized as a revenue. It will be recognized as revenue only when it is ready for use, ready to be delivered. It must be earmarked. The item must be on hand, identified, and ready for delivery. You cannot say that, look, I have to give in 3 months time now. Don't worry, sir. I got a production capacity. I'll give you after 3 months time. No. In that case, it is not billed and hold. You recognize revenue only in 3 months time. But you have goods 10,000 pieces ready with you, and you think that, look, he needs for next 3 months time. Now what I'll do, I'll sell it to someone else. He's not going to realize that whether I sold it to someone else or not, because he needs a staggered period of time of 3 months, and by that time I can recoup. No, it's not that. That is it. Item must be on hand, 10,000 pieces on stock, identified. These are to be given to ABC company, ready for delivery. I can deliver it today, sir, but I'm delaying the delivery because you only are telling that I don't want delivery now. Sale is recognized rather than that being a simple interest. Okay, so in this case, regardless of the delivery at a later stage, it is considered as a sale. Now these are the various conditions, special terms as summarized here. These are given at the end of the standard. This is not my work. This is compilation from the standard. Now this is something very important. Sell and repurchase other than the financial assets. That means sell and repurchase of the selling the goods and repurchase of the non-financial assets. No sale to be recognized, difference is to be recognized at the finance charge. I'm selling goods for 1,50,000 and I'll buy back after 15 days for 1,60,000, which is nothing but on paper you say it is sale and purchase, but actually is a finance. So this is nothing but 10,000 which I paid to buy my own goods or similar goods is nothing but the interest. Monica ji or any other operator from the
Yes, sir.
institute,
Yes.
I'm putting my video, I'm putting my this change because I'm not sharing now because I need to change, I need to move to the third slide, and that is for the
Yes.
borrowing
Yes.
cost. But in the meanwhile, you can ask the participants, are there any questions or not?
Yes, sir. We have 3 questions, sir. I will share
You-
my.
Yeah. Tell me.
Is my screen visible to you, sir?
Yes. What if there is a damage for new asset insurance is claimed, sir? Is this concerning the revenue or property plant equipment? For new asset and insurance is claimed. Sir, it's a new asset. I believe this is concerning the property plant equipment. So you bought a new asset, you started using it, and there's a damage, and you claim insurance. In that case, the insurance money is to be credited to profit and loss account. Asset is damaged in transit. Even if the insurance amount is to be credited to profit and loss account, sir. Now, asset is in transit, and it all depends on who has the title. I presume you have the title. The one who bought it has a title. Okay, in that case, it is again to be credited to profit and loss account, because when you damage it, when there is a damage, you must have incurred some expenses also to clear the damage, to cover the damage, right? You cannot say that this flask I purchased and it is damaged, and so then the water, the moment I put water, it comes out. You will not do that. You will repair it. So you incur some expenses to clear the damage, to repair the damage, and in that case it is to be profit and loss account, unless it is of a high magnitude, very material, that you need to spend almost 60% of the cost or something like that, material amount for the repair, because then it will be treated as an addition to the asset. Is unbilled revenue different from the work in progress? I want this gentleman to come up. Gentleman, who is that, please? Who raised this
Yes,
question? Gentleman or a lady?
I will check, sir. I will check who has raised this question.
Okay. Now this phrase has been used. This phrase has been used in Division 1, Division 2, and Division 3 of Schedule 3 to the Companies Act. And they say that when you are giving the aging analysis of both the trade receivables, you have to show this separately, the unbilled amount. Now, like this, there is a phrase called contract assets and contract liabilities under the Ind AS 115. Now, in that case, unbilled expenses means you need to incur some expenses for the bill which is not been received. This is the expenses side. But when the question is about the unbilled revenue, that means you have what you are talking about, the work in progress, is construction work in progress, and that is kind of an unbilled revenue. So let me explain you very quickly. The cost to complete the contract is 1 crore. Revenue on this contract is 1 crore 50 lakhs, and 30% is the work in progress as certified by the agency. So your cost to be recognized is 30 lakhs. But in this case, you have spent 35 lakhs. You paid 35 lakhs. So 5 lakhs is known as the unbilled revenue. That is known as a construction work in progress, but kind of a unbilled revenue. It is same as the working progress. Tomorrow when I'm going to give this, the account of the services or the CWIP, construction working progress as per age 7, you'll get the fairly good idea as to what is the construction working progress and what is the unbilled revenue. That means you spend money for a particular item, you'll be entitled to revenue at some stage, but you're not billed it because you're not eligible to raise the bills for it. Since the work completed is 30% only, you recognize the revenue of 30%, and that is 45 lakhs only. Okay, sir. So this is whoever has this question, I salute him or her. Thank you so much. And now let's move. We are left with just 10 minutes, but I need to request you to extend my session by at least 15 to 20 minutes, if not more. And I
Yes,
think
sir. Yes, sir.
there should not be a problem because I don't want to leave something in an incomplete manner.
Yes, sir. I'll give you the presenter, right, sir? Actually, right now.
Yes. Give me the present, right?
Yes, sir. Have you received it, sir?
I just show my screen. Yes. Okay, I got it, sir. Hello.
Yes,
Hello?
sir. Yes, sir. Screen is
Yeah, I
visible,
got
sir.
it. Can you see? Can you
Yes.
see the screen on your end? Okay.
Yes, sir.
Okay. Now the borrowing cost is nothing but the interest cost. Not anything and everything which is spent as an interest or the finance cost need to be capitalized or expensed out. You cannot have two extreme ends. I cannot capitalize everything. I cannot expense out everything. So you have to find a midway. And that is whether to capitalize interest or not depends on some conditions. So we can say conditions apply. Now, what are the conditions? Basically, it talks about first, you must have borrowed the funds, you must have incurred the cost, and this cost must be incurred on a qualifying asset. You borrowed the money, you incurred the cost, but the cost is not incurred on borrowing on the qualifying assets. You cannot capitalize. That means you spend money for the inventory, you spend money for the project which can be completed in 1 month time. You spend this interest cost on buying an equipment which you buy today on 25th of April, and by 5th of May, the machine will start functioning. So this is known as a qualifying asset. Or maybe same 3 months time, 4 months time. You borrowed money, you incurred cost, you borrowed money exclusively for the equipment, but still you cannot capitalize it because it is not a qualifying asset. Now, what is a qualifying asset? We'll see later on. Now, what do you mean by borrowing cost? Interest and commitment charges on bank borrowings and other short-term and long-term borrowings. Amortization of discount premium related to the borrowing. Amortization of the ancillary cost, finance charges in respect to the asset acquired in the finance lease, and exchange differences from the foreign currency to the extent that they are regarded as an adjustment to the interest cost. So all this sigma are considered as a borrowing cost. Our question arises, when should I start capitalization? No, whether should I capitalize or not? If yes, when it starts. Second question, when it stops. Third question, what if there is a suspension? I repeat the question. Should I capitalize it? If yes, when it should begin? It's again yes, when I should stop capitalizing. And third is, what if I suspend activities during some time? Temporarily. And the fourth question, what if I earn something from the temporary investment? All this question you should be ready with, and I'm here to give you answers. Any borrowing cost that relate to qualifying asset must be capitalized into the cost of that asset. All of the borrowing should be recognized as an expense in the period in which they are incurred. So I am sure that if for me, To enable the capitalization of cost, it must be spent or used for the qualifying asset. A qualifying asset could be not necessarily equipment, but equipment which takes reasonably longer time. The standard has not defined that what is substantial period of time, but normally a year's time. So if you are developing a machine internally, if you are constructing office building, factory building internally, and it's taking 1 year's time, 2 years time, it is a qualifying asset. Even the inventory sometimes is also qualifying asset. When it takes longer time, a shipbuilding, an aircraft, or submarines and all this. So this is an inventory for the manufacturer, supplier. So even those are known as the qualifying asset. Investment property, which takes which takes substantially longer time to complete. Now, asset that are ready for intended use or sale when they acquired are not qualifying asset. I bought this equipment, I'm selling it next day, is my inventory. Even if I incur cost to buy this, even if I'm owning working capital facility, I should expense that interest and not capitalize. What constitutes is a matter of case. Normally, aircraft, shipbuilding, they are submarines and all this. Any item which takes longer time, substantially longer time, more than 1 year's time, is considered as a qualified asset. But mind you well, they've not defined the period. They're not defined the period, but they say normally, ordinarily they say it's 12 months is considered as a substantial period of time. And then borrowing cost form part of the acquisition of asset, which are directly attributable to either acquisition, construction, or the production. I call it CAP, C-A-P. Are the borrowing costs would have been avoided if the expenditure on the cost. So this is very important. This is very important that had I not constructed this, had I not carried on this activity, was this amount to be required to be borrowed? What this amount was required to be borrowed or not? So if this can be avoided, then it's fine. But if it is unavoidable, then it is treated as a borrowings. As capitalized as part of the cost of the qualifying asset when it is probable that they will return into, that is fine. That will help earning money for the company. Other borrowing costs are expensed. Now, entity must have borrowed. It must have undertaken some activities for construction of that equipment. It must have incurred a cost also. But and there are delays, suppose in between there are some delays. That means activity is suspended due to COVID. COVID suspension was not expected by anybody. It was abnormal. But as against that, let's take another example. You have undertaken a work of construction of a bridge in, say, Assam or northeastern right, and there you know that during monsoon for 3 months flat you cannot do any work. So your activity was suspended for 3 months, but it was anticipated, it was envisaged, it was expected. So even if you have suspended the activities, you should continue to capitalize the interest during those periods. Whereas in case of COVID situation, it was not anticipated by you that you have to suspend the activities for 2 months, 3 months, 4 months, 6 months. No. So the suspension of activities due to the unexpected reasons, you should stop capitalizing interest. In other words, you should expense out this interest. In case of the suspension which was anticipated, factored, normal, even it is for 2 months, 3 months, you suspended the activities, you should continue to capitalize the interest cost. Now let us take for one example. Apex issued 10 million unsecured loan coupon with a normal interest at about 7%, okay, 7.5% on April 1, 2015. The loan was specifically issued to finance the building of the new store, which meets the definition of the qualifying asset. So you have borrowed specifically. Now there's one more angle. Either you borrow specifically for a project, or you use the money from the pool of the assets, pool of the resources. I borrowed 1 crore rupees only for building. Fine, life is simple. But I borrowed 50 lakhs for the building, and balance 50 lakhs I used from the pool of the loans or the borrowings. One loan I borrowed at 10%, second loan I borrowed at 11%, third loan I borrowed at 8%. Now you don't know, money is a fungible commodity. You cannot say that this 8% has gone to this or this 11% loan has been gone. No. So there you find the average effective cost of interest. We'll see that. You find out average cost, basic. Now construction on the store commenced on 1st May. When you borrowed? 1st April. When you commence the work? 1st May. You cannot capitalize 1 month's interest, because the condition is that it must have been borrowed, interest cost must have been incurred, activity of that must have started. It was completed and ready for use on 28th of February 2016, but it did not open till 1st of April. Now, ideally, as I told you, all the cost, including borrowing cost, are to be capitalized only till the asset is ready for use and not put to use. So here, though the actual operation or actual usage of the asset is from 1st of April 2016, one should capitalize interest only till 20th February. During the year, trading at Apex other stores was below expectation, so Apex suspended for construction of the new store for 2 months period during July and August 2015. The proceeds of the loan were temporarily invested for the month of April 2015 and earned an interest of 40,000. Now see the catch here. I told you that interest earned on parking funds temporarily is reduced from the cost of construction. But during which period? During the construction period. Now, when I started my construction on 1st of May, when did I put this money in the investment, temporary investment? 1st of April 2015 for 1 month, for the month of April. That means I have not used this money for the, sorry, during this month, I have not commenced the activity of construction. I should not deduce this from my interest cost to be capitalized. Rather, I should recognize this as my income in my income statement. Now here, let us see the answer. The 7.58% is the interest, and April 1st of April 2015 till 31st March 2016. It's a 1 year. On at a rate of 7.5, my interest cost would be 7,50,000. Capitalization commences when the expenditure is incurred on 1st May and must cease when the asset is ready for intended use. So for how many months? For 10 months period. I should have ideally capitalized interest. But there is one catch. However, the interest cannot be capitalized during the period when the development activity is suspended. In the case of 2 months, July and August, that means interest to be capitalized only for 8 months. Only for 8 months. Because this was suspended. You getting my point? So what is the remaining 4 months balance cost of 2,50,000 must be expensed out. So only for, so the amount to be capitalized is 7,50,000 divided by 12. So how much do I get it? It's given very clearly. So I have to recognize interest only to the tune of 8 months. In other words, for 4 months I should recognize. So 7,50,000 divided by 12 months times 8 only 5 lakh interest is to be capitalized. Interest for 4 months should not be capitalized. Correct? So that will be debited, and investment income of 40 lakhs, 40,000 is not credited is credited to profit and loss account and not reduced from the interest to be capitalized. So you can see here 7,50,000 is my interest cost, but I capitalize only 500. I debit 250, 4 months interest. And here I am crediting my profit and loss account. Now let me twist this. Let me change the facts. The construction was commenced on 1st of April. So if the construction was commenced on 1st of April, that means interest for 9 months would have been capitalized. One more angle to it. During this construction, when they construct during this period, that is from April 2015, I have earned 40,000. So had construction commenced on 1st April, had income still be there of 40,000, my cost to be capitalized would be as under 7,50,000 divided by 12 multiplied by 9 interest cost minus interest on the invest on the investment income 40,000. So this would have been the fact had my income. Sorry, man, please. Had my incomes, had my construction started on 1st of April, and I would have earned the interest income on this 40,000 of the investment of 40,000, then 40,000 would have been reduced from the cost of interest to be capitalized and not credited to profit and loss. Now, specific borrowing is very simple thing. If they are borrowed generally, then you have to find the average cost. Now, this example is very good, and this will help you understand what is to be capitalized and what is not to be capitalized. On April 2014, a company engages the development of a property which is expected to take 5 years to complete at a cost of 6 million. For this purpose, bank loan of 6 million with an effective rate of interest of 6% was borrowed on 31st March 2014. So funds have been borrowed. Interest income had earned at 3% on the unapplied funds during the period. It says during the period, during the construction period. It is presumed that the construction is started on 1st of April. What is the amount of interest to be capitalized on 31st March 2000, 31st December 2014? Okay, this is given only for the 9 months time, right? Total interest till December 2014 is 2,70,000. Amount to be capitalized is 2,70,000 minus 114. Here is a difference because during this period you earn the interest of 1,14,000. During the construction stage you earn 1,14,000. Hence, to be capitalized is interest minus the interest income. Interest expenses minus interest income. Commencements of capitalization when the expenditure for the asset are being incurred. Borrowing costs are being incurred. Very good, important. You must have started the activities. You must have incurred the borrowing cost. Activities that are necessary to prepare the asset for its intended use or the sale are in progress. Expenditure on qualifying the asset include payment of cash, transfer of other assets, assumption of interest-bearing liability. That means you incur the cost. You pay the interest cost either by cash or by incurring other liabilities. That's what they mean to say. Expenditure are reduced by any progress received and grant received in connection with the asset. That is to find the amount blocked in the construction. If you spend 1 crore and if you receive the grant of 10 lakhs, then your cost is 90 lakhs. Activities necessary for the asset for the intended use is physical construction, technical and administrative work prior to the commencement. It is not that you should go to the site and work on even the off-plan balance sheet. Off-plan work is also important. That means you're preparing plans, you're getting submissions, you're making submission to the municipal authorities, you're taking permissions. All these are considered to be the work associated with the construction of an asset. Suspension of capitalization. If it is normal, if it is expected, keep on capitalizing. If it is abnormal, and then it is to be not accounted to. Like we see in July and August, it was not expected. So interest pertaining to July and August were not capitalized. Then what we have done? They are expensive. They were expensed out. Now, season of capitalization, we have seen that when the asset is ready for use, not put to use, the stoppage of the capitalization. Capitalization stops, depreciation starts. Okay, so even if it is regardless of the pendency of the routine admin work or the minor modification, you stop capitalization of interest. Now, interest accrued during the period between the completion and the resale is charged to profit and loss account. I'm building up an aircraft. I'm building up a submarine. I completed it. So I'll stop capitalization. But my resale takes place up 2 months later. My sale takes place 2 months later. I should not capitalize interest for this 2 months time. That interest should be expensed out. So I stop capitalization the moment it is virtually ready for use. And when it is completed in parts, you capitalize in parts, and you decapitalize. You don't capitalize when the things are ready. So there is 3 rings. I completed first ring, so I stop capitalization. Continue capitalization for the second phase because it is incomplete. Stop when this is completed, and likewise. Now let us take this very good example. This will tell you that the company has borrowed something from specifically for a project and something from the common pool. It's not that if you borrowed 50 lakhs, you should straightway charge as 50 lakhs, but you should do how the money is spent over a period of time. You don't spend money on the day one. So there they say how it is to be calculated as to the what is the capital employed. Okay, 10% 4-year note with a simple interest payable annually, which relates specifically to a project, and the debt is 7 lakhs. Interest of 65,000 was incurred on these borrowings during the year, and the interest income of 20,000 was earned on these funds while they were held in anticipation of payments. So they have not started the work. On this, you incurred a cost of 65,000 and you earned an income of 20,000. And this was, I think, specifically to project. That was a specific borrowing, not the common pool. Then second borrowing is 12.5% 10-year bond, which is 10 lakhs. And again, 10% 10-year bond for on 15 lakhs rupees. So how you should do? 12.5 on 10 lakhs, one amount. 10% on 15 lakhs, second amount. So add up the interest, add up the borrowings, and find the average. Working is given here. But let us see now. Here is a merger. What is merger? That though the amount has been borrowed specifically, you had incurred 200 in one. Till September 9, you have incurred 600. Till March 2010, you incurred 1200. And till June, you incurred another 200. So totally, actually, if you go to see, up to 800, you have used funds of 700 from this specific borrowing. You've exhausted this 700 million. That means how much you used from the common pool? 100. Now this is again being used like this. 100 means you started from July and it is going to be completed in the second year. So for September to March, from April for July to from September to March, you use these funds for 9 months. Again, from March, you use these funds only for 3 months. And again, when you 30 June completed, this fund was used only for 0, right? So 200 into 0 divided by 12 is 0. That means this money was blocked only for 1 day. Weighted average period for this money is 375, and it is not 1200 or 1200 or plus 200 or plus 100. Here you found a weighted average for the number of days the funds have been used from the allocated general borrowing. 700 you use perfectly, that is fine, and for that the working is here. 65,000 you earned, 65,000 you earned, okay? 65,000 you paid on here, please. 65,000 you incurred on the specific borrowing, and 20,000 was the income earned. So it is here. First is 65,000, and then 20,000 you reduce, okay? So that is one equation. Now second equation is as under. 12.5 multiplied by 1,000 and 10% of 1,500. You add up 1,500. You add up your cost of this, okay, and then divide by this two amount. So this is the interest of 12.5% on 1,000 on 1 million. Second is 1,500, 10%. So this is the amount of the interest you're going to incur, divided by both the principal amount. So there you get 11% average rate. So whatever interest you spent on loan 1, add interest spent on loan number 2 divided by the principal amount of the loan. Principal amount of the loan is 10 lakhs and 15 lakhs. This is the interest, this is the interest, this is the principal. You get average 11%. Now, what you've done, sir, you use this fund for 375 currency unit. So 3,75,000 into 11% is the interest to be capitalized on from the general borrowing. So 3,75,000 times 11%. This is the interest cost to be capitalized from the general funding. This is for the specific funding. Since you earned income from this specific borrowing, this is going to be reduced from the interest to be capitalized, and the amount to be capitalized is 86,250. So this is what we see. So here what you see, friend, is like this, that whatever money you spent here on the project, okay, what is the project cost is about okay, this is 2,200. You not spend this full money on day one. You not spend this full money on day one. So because they have been spent in a staggered manner, you find this as an average cost, weighted average period, okay? And that's why though you spend about 600, 1,200, 200, your actual money which is being tied up in terms of time value is 375, 3,75. So this is how you should do these calculations, and these are the various disposals to be made. I'm not going to do it much. So friends, this is what I had to say, and exactly you had given me an extension of almost 20 minutes. Monica ji, please ask your ask my viewer if they are there till now. Are there any questions, please?
Yes, the members are there, and questions were like stopped around 8 o'clock, sir. So those were the questions you were like answered, sir.
Okay, fine. Okay. So thank you very much, ma'am, for giving me an opportunity. And I feel very gratified that I had a chance to deliberate and dwell on the very first day of my new year of my life. Okay, I'm grateful to you all for being there and the patient appearing. Any questions, let me know. Hello.
Read the questions, sir. Those are like,
So can we call the day off, ma'am?
yes, sir.
Ma'am, can we go for a vote of thanks, madam?
Sir, yes, sir.
Sir, first of all, this a happy birthday to you, sir. Because
Thank you,
while
Sri.
I'm reading your profile, I don't know today is your birthday. Happy birthday to you, sir. Sir,
Thank
and
you. In
also
fact,
you look like
I'm grateful to SIRC for advancing my this program today, because there was a specific request from WRC that tomorrow's inaugural session I should be conducting, and hence I requested with folded hand to Monica ji, and she helped me a lot that she advanced this session today. Otherwise, it was scheduled tomorrow. So thank you to all of you for accommodating me.
Thank you, sir. Thank you for your wonderful presentation and accepting our invitation. And I thank all the participants. Even after 20 minutes, there are many participants there in online, sir. So thank you for once again. I thank you on behalf of SIRC. So thank you for your presentation, sir. Thank you, sir.
My pleasure, sir. Okay, sir. Friends,
Thank
good
you
night,
so much.
everybody. And take care.
Thank you, sir.
Take care of
Good night to all.
yourselves. God bless. Bye.
Thank you, sir.
Thank you so much.
Okay,
We'll
okay,
end the
Monica.
session.
Yeah.